much guiding the market. So I think it's sort of sailing blindly, one would say.
Or waiting. Watching and waiting.
Watching and waiting.
Yeah, you know, it's interesting as well, like there's slight pause, but really it's still overall, I have to say, looking like cautious to risk on, right? But it remains to be seen whether we will have the catalyst of inflation.
And is he doing it with Harris?
Yeah, he is. He's ex-Credit Suisse as well, and he is doing Elliot. They've already been put in touch by me. Elliot is going to take us through all of the mood music from the volatility side of things, and we'll explain how it looks like the data may make things slightly interesting for us. So stay tuned for that if you're looking for entry or exit points. Then we got all sessions opening. Actually have already sent your questions in from everything from Sarabi to Greatland. Do send more questions in to us@ig.com or indeed in the chat here. Slam the like and subscribe button because we're going to get you instant analysis from John Mayer from SP Angel after that.
And not to be confused with the artists.
Yeah, yes. Was that what you were thinking, Ronnie?
Yeah, that was my initial reacting.
We'll obviously be talking a lot about gold because yesterday gold plumbed higher, didn't it? It hit the 3,000. I'm just going to try and get it up there. Yeah, and it's still above that 3,600 mark, friends. Thanks. I've only just managed to erase Spandau Ballet from my memory. It's taken a lot of therapy for that. So we will have Simon Popple talking about gold, but we'll also be talking about gold miners with John Mayer. Right, so let's have a look at overnight action, shall we?
Yes, let's see what's up there.
Right. Hey, trader friends, welcome back to Overnight Action. And we start with the front page of the Financial Times, where we've got news on big oil slashing jobs and investments as low crude prices bite. This is according to the FT, because the industry is warning of flashing red warning lights because executives are bracing for a downturn that may last years, says the report. What do you think of this?
I think it's kind of interesting to see how the different sectors of the different players in the market react. As you know, big oil, and this is referring mainly to the American majors. They are looking at it conservatively. They're taking a defensive approach. They're saying we're nowhere near our break-even level. It's just not profitable for us to continue to do this, and they need to focus their efforts on where it actually makes money. So, for example, in Guyana. And then we have, on the other side, we have the complete opposite, which is the OPEC Plus agreement, who have all now agreed to defensive majors is more than necessary in order to have some sort of balance in the market, because the price will be pumping up at $40. I'm quite understanding about my investment and my spending at this point in time with topic in the market.
Many years ago, your went down. Look, guys, shot. A big of pocket change, really. You look at things like carbon capture, some sort of beyond petroleum. Now, they have now decided, you know what? Now
It's all just fun. that's the theme for the next few years. However, not everyone are at ExxonMobil now with the acquisition of Hess, they are now in excess of 11 million Guyanan oil. I meant it with, I'm trying to learn. I meant it with, I apologize to all my Guyanans. Is the sort of offshore that will come from is now in billion acquisition. It's an interesting one to watch, especially with a company like BP that's been a bit of a for some time. The restructuring's been going on there for quite a long while, and I'm watching with interest now that state oil producers are also doing the same thing. It used to be, Ronnie, when you said you worked for a state-backed, it's like, if it's houses, the only constant money man saying, and Julian, interesting. Surely then, that was exactly what I thought. Saying that Trump, China and Russia all now best buddies.
So they're being used to settle with each other. All that means, if you want one gas, mention more gas, but he also mentioned for Europe, a lot of that is being sold off already to other consumers elsewhere, whereby the demand eventually. Really some good John from that. It's Robbie. Let's start it moving. Since I've been away on holiday, maybe I should go on holiday a bit more.
Why not? You deserve it, Ange.
Scotty Monkey saying, I think the comment was we'll talk to John Mayer about that later. Good morning, Kate. My goodness, Kate. Kate Murphy's one of our traders and investors all the way, normally from the Antipodes. Too, because James and Dom have been in here early, jigging up the lighting. Do you like this new lighting? Maybe we should have a vote, James and Dom, about we've got blue, pink, purple, anything that you like. TARDIS 35. Morning. Right, let's checking in on the Times for you. Times front page. We've got some stories to do with NHS Hospital Trust, but also just taking a look at the UK, because when I was coming in earlier, I noticed that there was an interesting story about Cornwall. It should be recognized as a nation according to a recent petition. What do you think of that?
You're asking the right guy here. Obviously, someone with Kurdish roots. I'll always take the side of the independent self of independence. So yeah, Cornwall. I'll support you guys. I'll come out. I've never been, but if they go independent, I'll go out there and I'll consume to stimulate the economy.
Amazing stuff. Steve CDR, thank you for letting us know your thoughts. It's wonderful because obviously I can't be on that side to hear and see it. Steve CDR says lighting's great, sound is much better too. Derek saying Anglo and tech to merge. Thank you of that. Blue Elegy, we take that. Blue Elegy saying we all look younger.
Hey, I'll take that.
I'll take that.
I need it today.
I need it too after this morning's journey in. CNBC, just checking the front page of CNBC for you because of course, lots surrounding not just the news about how European stocks looking set to hold steady or dip at the open on Tuesday, because there's a lot of focus on the further turmoil in France after the ousting of its PM. I mean, its political landscape there is a bit of a mess, to say the least. But also, we have CNBC looking at Klarna's IPO.
Because it is the product of my home been But from the 23 active merchants, Klarna 790,000, firm 377,000, revenue 3.1 billion for Klarna, 3.2 billion for the reason why sort of a paper loss, if you will. Year on year, to look out for, but do you want to share? Are coming up, and you can bet on what you expect them to what you expect them to IPO in market cap, above or below what they're trading at. So if you believe that the even more than 14 billion, then you can trade this on the Klarna IPO, or you can do the same with Gemini's IPO, or Monzo, or Revolut's IPO, all of these coming up. And your bet will be null and voided if the IPO doesn't go through. So if something happens and Monzo's IPO doesn't go through within a year or so, then your bet will be null and voided. So I think have a look at these and the sort of prediction markets. It's something that I think is really interesting. And yeah, put your money where your mouth is, unlike me.
I am going to watch the Klarna IPO with great interest, and I'm sure our Sachs will as well, because we had positions on a firm earlier on in the year. Just going to show you my chart here, and then came off and took profit. A firm now, one of those that you can trade extended hours. Oh, we need to talk about that too, Ronnie, because well, let's do it after this, because we've got you know, lots and lots of stocks now that you can trade extended hours. And as you can see here, a firm has had a really, this is daily chart, it has had a very choppy ride, although it has been pretty much upward trend since April. However, very, very choppy there. What is also interesting is that at the moment, Klarna, as you rightly say, has got you know, a lot of potential in terms of growth. But because it's trying to grow at such speed into many different spaces, a lot of these buy now, pay later, they get you in first, right? Just like a lot of fintech, they get you in first on these promos, and then in the hope that you then use other offerings that they have. What I want to show you is pay attention to this chart, because this, if you are looking at being active on the IPO, this is to do with the revenues, and if you take a look, it's growing a lot more slowly in some of the markets, especially some of the markets that a firm is already strong in, right? Look at Sweden, negative 13% there. But the one to look out for, the most important one, is the US, 35% there. This is the year-on-year revenue growth rate based on the period of 6 months ending June 30th, 2025.
Yeah,
So,
I think looking at that, I think some people might be frightened to see that they're shrinking 13% in their home market of Sweden. But because Klarna is so integrated into the Swedish economy, and it is such a big part of the Swedish consumer, it already dominated the entire market. So it's natural that it falls back as other competitors enters. But what is interesting for me is that in massive consumer economies like the US or the UK, look how much they're growing, 35%.
yeah.
Now that's interesting, and that's something that I believe is positive for the future growth of the company. So I am bullish on the Klarna IPO.
I love how this is how a market works. I am slightly bearish because I think the consumer in the US has been lent on for a very long time, and cracks are starting to appear. We're seeing that unemployment rate tick higher as well, right? I was out in force. If you want to see a short on that, I've got it on the YouTube page as well. And I just think you can't. We've seen the US consumer deliver over and over again, and at some point they're going to have exhaustion. You are right, though, that it is, if we saw Klarna's IPO at an implied multiple of just 15 times, it would be a big discount to a firm. I just think you might have to wait a while until, all those good things surrounding Klarna comes through because of that weak consumer or weakening consumer picture.
I think that's exactly why I'm bullish on Klarna and any other sort of...
Because you think people will spread out they'll still buy, but they'll spread out the payments.
I think we'll see a sort of lipstick effect where with the economy contracting, and the consumer being more selective with how they decide to spend their money. So instead of making one big purchase on a purse for $2,000 or etc., they're instead spending a little bit more on a nice lipstick for a couple of $100, or I don't know how much lipstick costs.
That's how expensive it is.
But the lipstick effect basically saying that as the economy is contracting, consumers spend a little bit more on selective purchases rather than on a wider variety of purchases. So Klarna will come in for that.
And on that note, we have a US stocker here. For Guess the Chart, we got to go straight to it. Others will miss the opening bell, so let's do this.
Well, the footsie's dancing in the morning light. Shots on the screen and the game's in sight. Axel's got a trade, says it's looking hot, but Rich is clicking faster than a scatter shot. Haynes lanes in, says, hold on, boys. I've got questions, don't make no noise. Producer Phil says, here's the next slice, and please remember, not financial advice. Guess the chart, let the fiddle cry. Is it shell or rose? Will it soar or die? chart, let the fiddle cry. Is it BT's break or Tesco's high? Trade life with IG, where we're riding high. Phil's trying hard just to trick your eye. One fiddle's blazing, the other's fast. Just like a chart when it breaks at last. Hands on.
Hey, welcome back to Opening Bell. And I love London, guys. Come on, let's get us a try. Who cares? Let's rock out to the tune. Ronnie and I were rocking here, but I think Ronnie and who was it? Was it our Sax that got first to the, is it app?
AppLovin. That is my prediction because I was reading about it this morning, and it said that AppLovin along with Robinhood have been bumped up to the S&P 500 to be included in it, and that it was trading at roughly 555. And then I saw the price at 548-ish, so that was my guess. And then I saw that my fellow Scottish countryman Hamish agreed, and then that sort of confirmed it for me.
Yeah. And just a reminder too, well done, our Sax AppLovin indeed. We've got a ton of new things on the site. I'm going to use a new bell.
A new bell.
A new bell. I'm already getting from people internally as of last night, because the Saudis will be arriving in force to have a grand
Excelling
presentation.
in Custom House.
No, in Excel, not in Custom House.
You know what?
They're there doing a huge defense store. Airbus as well, down 1%, and Safran also down 0.2% there. Elsewhere, let's check in on. Let's see. We got Germany. Let's have a look at Germany now. The Germans.
Yeah, and you know, Germany has a special place in my heart nowadays. We have, I mean, it's very much the same here, that we see the sort of Volkswagen, Mercedes, Deutsche Telekom, E.ON. So it's the sort of everyday not everyday consumption, but it's a bet on the German consumption coming back. I mean, Volkswagen and Mercedes have been absolutely hammered lately. So I'm very happy to see that they're actually getting some sort of relief and return. But there is the challenge with China remains for the German automakers. What I'm looking at mainly is to see how they can do with how effective they can be with their $500 billion stimulus. But yeah, it's interesting to see here because all the automakers are up, even Daimler Trucks. The banking sector is up. The utility sector is up. Is that a defensive approach in your eyes, or what do you make of it?
I think it's just a pause for breath, and the market's thinking, let's put some money to work elsewhere whilst we're waiting for all that macro data.
Yeah, and also I think the valuation of these companies, especially the automakers, have come really attractive with the constant sort of downbeating of them. So I think for anyone looking as a value investor or a fundamental investor, I think Volkswagen and Mercedes, they pose as actual great opportunities in that sector. Because you look at the stock, it's been absolutely murdered.
Really battered. Let's have a look at the monthly, see where we are. Look, it's been really choppy, but you're right. It's been absolutely brutal for some of these car makers, especially with the tariff situation. Let's have a look at some of the losers now. Commerzbank down 1.2 there. Rheinmetall also down 1%. And we have Porsche, Bayer also down there. SAP, interestingly enough, is down 0.5%. And we've got BMW. Oh, BMW is not on the winners list, not like Volkswagen.
Interesting.
And Renault. So just checking on a couple of names here, just taking a look to see whether we have any movement in terms of UK retail type stocks. Do you like any of the grocers? Where do you shop?
I shop at Sainsbury's, so I can convert my Nectar points into Avios points.
Oh, nice one. Look at you. Yeah, we'll do this in fast markets in a moment because we have some news out of the retail sector, so stay right there. And we've got Gavin Ackers coming online to tell us about ASML as well. So stay right there. We've got fast markets coming up soon.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, You've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from on your journey.
Hey, welcome back. The big news that's rocking the markets at the moment.
To tuck my shirt in by the producer team and see that it's actually
Markets, right? We want to talk about
yes.
ASML.
It's one of those stocks as well that cannot trade robust production of chips and the technology and the been labeled as gold rush of AI. Fundamentally European LLMs, I think
Gotcha. You often come on the show, don't you, when you say that ASML is one you buy for your grandkids.
That is what my friend, that is what my equity analyst friend at one of the, if not the biggest asset managers in the world said.
So this is the thing too with ASML. So we had a grand discussion yesterday with Julian your positioning, and his views on hardware go gaga first. So, you know, like this wonderful new studio, you have to build a studio, but after you build the studio, you don't have to have, you know, equipment. You need software, you need, you know, things to work, you need, you know, things to make the hardware work. And so are you in the camp where you think ASML, I guess it's a longer term play for you, you'll continue to need that hardware power in the next 10, 20 years, whatever your horizon, investment horizon is? Or do you think we're going to see that hardware, if you're near term, really sort of not kick off, because we've seen a lot of the hardware being bought. I mean, we've seen, you know, Nvidia's reaching all-time highs, right? Yeah. And so there is also duration. We always talk about duration here. Understand your event horizon or your investment duration.
Yeah, so I think the biggest dependent is the sort of the mega spenders, the Amazons, the Metas, the Alphabets, the Microsofts of the world. Unless their capex remains consistently at the levels that they are, I don't think we're gonna keep seeing that sort of infrastructure and hardware spend. But in the longer run, I think it's still gonna be dependent on this technology.
Yeah. Right, we're going to quickly also show you the winner of Guess the Chart, and I believe it is R. Sachs. You got to AppLovin first. Well done, R. Sachs. It is indeed AppLovin. Now, you don't have a view on AppLovin, is that right?
I don't have a view on AppLovin, but let the record show that in the commercial, Andrew's telling me that she's not a fan of AppLovin, even though AppLovin has now been included in the S&P 500 and is up. If you get the chart up,
yeah, as you
bash the stock, get the chart up. So
as I bash the stock, I'm not saying that I'm not a fan. I'm just saying that it's not one that I have, you know, have had an adventure with. Let's put it that way. And I know that a lot of people, Monkey Man, one of them, is you know, hardcore, you know, loves talking about AppLovin, but I don't know why. I just haven't actually got into it. And also these lines. So I'm looking at this from a technical viewpoint. It is rather choppy. I like momentum trading, and so if I were to have you know, entry point and a stake in AppLovin, I'm going to highlight this for you, friends, so you can understand what I mean, because I like it when I see a rainbow formation like this. Can you see that your 50, your 20, and your 100 look like a rainbow and the price action is above? However, right now, this is looking good. We can see that perhaps maybe from August 20th, we're starting to see this rainbow formation once again. But I would hasten to add that I would have my sort of spidey senses up if I saw this. Can you see where I am?
Make strong, it's going to continue to rally because they obviously have the market cornered, and that ecosystem is so big.
Be ordering. So there's going to be a new version it's just I capability in the software side. However, little has
my friends brought it for me. My friends bought it for me, and my lovely girlfriend said, "Oh, I really like the book. It looks great on you." It's great. Whoop.
Ooh, what is Woo?
It's like a health monitor band. So you have the band on.
Ah.
And then you have an app
that was the turn off the Apple wine or your big steak, or something telling you don't do it, don't eat it, it's going to be bad for you. Right. Friday, there's a doco, and I think it's a podcast done with BBC companies that have so big Kodak was one of them, and look at Kodak now. I mean, no one really knows what Kodak is, but back in the day, everyone went out, everyone bought Kodak film. Right, we got Elliot Harris waiting in the wings, and also Scotty Byrne will be with him to talk all things volatility and what that side of things is showing us about the markets in the next few weeks.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Hey everybody, welcome back. A little break for Andrew and Ronnie, which is well deserved after their hard work this morning. And we now have Elliot with us from the Vol Desk at IG with the live from the trading desk segment. We're going to talk about all things upcoming, not only this week, but potentially reaching to next week as well. And some of the things to look out for with markets. We might touch on IPOs as well. And of course, please keep the questions coming in the comments. We're happy to touch on anything that you guys want to have a look at. Now, we've got a great note from Elliot already. So I'm going to hand over to him to start to go through some of his list of identifying factors that we should be looking at over the next few days.
Thanks, Scott. Yeah, quite a big week. It's a relatively slow start, I would say. Didn't really see much of a market reaction to the French news yesterday. Europe's up small this morning, but a little bit of a bounce, but no real shock there. So haven't really got too much of a story. No real surprise. This week's basically very much back-ended. You've got the CPI on Thursday, which is very highly anticipated, obviously being the last key piece of data before the big Fed next Wednesday. You've also got some UK data coming out on Friday, and you've got the ECB also on Thursday. So fairly big week, as I say, very much back-ended. One key piece of data coming out today, which is definitely worth keeping an eye out for. It's a report from the Bureau of Labour Statistics. It's basically their annual revision of non-farms. Now, what we've seen over the last 3 or 4 months have been some decent revisions, which Trump hasn't been too pleased about. But you may see between 550 and 800,000. That's a figure that I've seen from Goldman's shaved off in terms of the revision. So if that happens, I would expect a decent sell-off, certainly on the initial release of that. Yeah, so that's kind of the main focus that I'm focusing on for the rest of the day.
Yeah, I think that's at 3 p.m. UK time. Is that right, Elliot? Yeah, absolutely. So again, that's always a prime point after the first half hour of the US. Things settle down, and another curveball comes into the equation. And just this is very much a trend as well, isn't it, from the BLS, where some of these jobs are going missing, which is what's upsetting the Donald as well.
Yeah, the revisions have been...
Have you seen anything about what this is attributed to, or is it just sort of slippage of information?
I don't think any story at all on it, no. I was Googling it actually yesterday. And
Tariff, love the tariffs.
I can understand that it's not best pleased because every time it's a decent miss, so...
Yeah, absolutely. It is interesting though with this jobs data, whereby, as we said, the market, as we were talking off camera, where even if it misses 800,000 jobs, market might drop 1% or 2% and then actually rally back up again. It's just very much in that setup.
Yep.
And I think for a lot of people like myself, I'm a bit sort of old school. I was taught in a particular way from certain people, and there's just certain things happening in the market which I think a lot of people are not understanding. For instance, if we could just touch upon, so I've kind of slightly stolen this from somebody else anyway, but it was a chart actually of the S&P versus gold. If we could just move to chart, so that's the gold price in red with the S&P going up. Now, I don't know about you, I don't generally see that kind of racing out performance from gold. Do you think that potentially the market is saying there's a policy mistake coming?
I'd be surprised if the market takes it that way. Gold and also silver have been very strong. Gold is actually the only asset class out there currently where RV is actually over IV. Generally, I do, and what I mean by that is implied vol against realised vol. Generally, what we've seen over the last 4 to 6 weeks is realised vol, certainly for the second half of August on the index front, it's been really quite low. But gold has had a real decent push. Silver, I came on a couple of weeks ago and actually said that silver tends to lag gold a bit. So I think when we spoke, the two weren't too dissimilar in terms of their value. Now you're talking silver's 500-600 points higher. So a lot of action on the metals front. Reasons why? Yeah, it kind of covers a couple of themes. I can see interest coming into it because USD weakness we've seen over the last 4 to 6 weeks. You've obviously got some threat to the independence of the Fed as well, which we haven't seen for a long time.
You mentioned, which I think.
And also it's a natural asset to cover you for inflation risk. So it's kind of, it makes sense to kind of see so much flow going into that.
No, no, I think that's very fair. I did. I think it was in your note as well, where you mentioned about potentially some of the data might show that Powell could have cut earlier this summer, and as the Donald likes to call him, too late Jerome Powell, pretty frequently. Again, I mean, I have read criticism whereby in COVID as well, he was so obsessed with the jobs data, he was too late to hike. So again, with the greatest respect, I couldn't do that job. I don't know about you, but I definitely couldn't be the chair of the Federal Reserve. But
I wouldn't fancy it, no.
It's,
I won't be applying.
No, absolutely right. But yeah, it is. I think it is an interesting set of factors to have this central bank uncertainty. I mean, I can't think of the last time the Fed were that openly criticised, even when Trump was last in power.
Definitely.
But again, markets are lower. It just went up anyway. He created that market economy. I can't see how a country that basically is reserve currency status, is the lender of last resort, is able to basically insult the governor of the Federal Reserve in such
We'll find a way.
But yeah. Status.
weakness, the last 4 to 6 weeks. Like, and we're coming to expiry.
Meeting and expiry. That always used to be one of my favourite times of the year. Sort of any particular level to be okay.
Got that off the Bloomberg this morning. Still price what you pay 65.50, maybe 66. Would be a huge amount, but
a bit of divergence between the cash and the RSI. So a bit of negative. But he's talking about marginal. A big shock to the downside.
I did get, which I had my little piece that I write up before I come on. Expect concentration in the Mag 7 now at 34%. Now,
Wow.
The last time that we saw this, that's been a high in quite a while. The last time we saw this, S&P
really
came off 13% on average within 20 to 78 trading days. So, obviously, that's a statistic, which could all be thrown in the bin in a couple of weeks' time. Who knows? But certainly, I've had clients that are beginning to look at 3 or 6 month put spreads. So buying the closer to the money put, selling a deep out of the money put just for protection. This chart here, this is actually a gold chart here. This goes back to what I said at the start of segment, where gold realised vol has ticked up, but you can actually see. I'm pretty sure that that is a gold chart. It's, in fact, IV's on the okay. This is slightly out of date versus what but you can see that sharp jump in the IV, roughly 18%. It's about the only asset class where IV is off the lows. SPX vol, Dow vol, even crude vol are all kind of at close to year lows. So gold
and for
is
some of our viewers out there who might know, IV is effectively, it's like a demand function. Is that a fair way to explain it?
It's kind of the market's expectation of what's coming, if you like.
Right, okay.
So IV across the board, every other asset class apart from gold and silver, approaching year lows. That
is actually quite interesting, as far as I know. You're saying, looking at the dates, it's not as up to date as you would potentially want it, but that actually came, that jump in implied vol actually came when the gold price itself was doing very little. And the amount of the commentators I saw out there saying, that's it for gold, it can't break out, it's going back to 3,000. It's a little bit like we were saying yesterday when we were talking about, when we were speaking to Julian Wheeler, who was explaining about some of the tech stocks and some of the some of the aspects you need to look at and understand. This is another part. This is like only looking at, say, the price action of something without looking at the fundamentals. So for anyone who's out there, I know that some of the phrases that we use in this segment might not be ones that you're necessarily familiar with, but these can all be explained from your contacts IG. I'm sure there's explanations of this on the Academy as well.
Exactly.
But when nothing's happening, generally nothing is ever happening. There's always something happening under the covers, which makes
that's where options are great because, whilst things might be relatively quiet now, the market's expectation of 1 week, 1 month, 3 months, etc. That can almost give you a forward guidance of what the market thinks is on the way, effectively. So, yes, volatility is low, but that's often a good time to be able to look at options. So,
yeah, absolutely. In fact, that goes nice into Pelican, who I've noticed from yesterday is getting very fond of the big pink waving hands because that's grabbing our attention as if we're at some sporting event in the US. So if the IV is low and spreads are vastly wide on Jan calls on a stock, wait and see or look to give it a miss. I appreciate that's a slightly open-ended question, but this is probably so for me, for my take, I think you have to get the seasonality in perspective as well. So if you're looking at a January call in September, the prices are going to be wide because what market maker is going to sell it to you? So that's a really key thing, because how many people have said to you, oh, options, waste of time, 78% of them expire out the money. I mean, as we know, that's not true, right? That's not true. However, it's a case of, it's a bit like analysing a stock or analysing a company's earnings. You've got to think to yourself, right, if you're looking at something that far out in time, because as we know, time is expensive in the options market. If for addressing that question, what would you look to change? Is it the actual underlying stock that will change first and look to trigger a move in the options? Is that a fair assessment, or might the options move first, or do you just have to watch both? Is that?
Yeah, you're going to get very different answers depending on the stock here. If you're looking at something where Nvidia, your Tesla, where IV really looks like
options are just even for what the stock.
got from being able to trade something that you have from time to time. There are more options going through, and there are which is yes.
see as well. Institutions use options a lot more as well. Spot markets.
Yeah, like if I just chuck in, just in terms of,
Brilliant.
We also do 0DT options here, and these trade on exchange. Hit a new record in August. 2.4% of SPX options on the CBOE were going through on the 0DTE contract. So that is a monumental jump.
After that.
Absolutely. Yep.
Incredible stuff. Right. That
you run out of time because make really Klarna to start price tomorrow. Deny the crypto exchange going live on Friday. So check those out. We're seeing lots of flow. That's a bespoke IG market.
Yes.
So
yeah.
worth a look.
That's what you call finishing on a high.
Absolutely.
Right. That was Trade Live. That was live from the trading desk with myself and Elliot, and we're going to go to a break. Thank you again. That was really informative. Thank you.
Thank you.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
We
That
know
is
from-
honestly. But Nottingham Ball.
Thank you, whoever
Sorry,
you
mate.
are. Below.
A bit like when you're on a plane, a bit of a stomach churning
Yeah.
drop when you get to turbulence.
Yeah, and it looks like maybe there might be turbulence ahead, or maybe we might see a bounce up. This is the daily chart you're looking at, and if there is a bounce, then maybe we could go back towards that August high, which is the last high there that is of interest. The other big thing that I also want to have a look at, so let's just go back to all sessions there. Is we talked about Coinbase earlier on. That's not a huge surprise given the movement we had recently on Bitcoin and Ether as well. Ether, I'm hearing a lot of people talk about a second leg up after that big move in the last month or so.
It's a pretty wild instrument, Ether, isn't it?
It is wild, but it's actually one of the relatively less wild ones if you're...
Yes, true enough, true enough. Novos
yeah.
again, we had Novos on the naughty list yesterday, didn't we, at the top there?
Still on the naughty
Another
step
one,
there.
so that's not. And again, I think that's a great... So this could be a great one as well, to have a very quick look at the chart, because I don't think we've got long. This is another one where, when you were speaking to Julian yesterday about, and I'm sorry to mention this, Lulu, where when you're looking at price action, don't try to catch the knife.
No.
And I know that we looked at this yesterday, so apologies if we're repeating ourselves, but as you can see, you've got your Ichimoku's there. It's just cresting lower again. So again, we can look for those extra tests of those lower levels, but again, that just definitely looks like one that's going to stay in the stay seated on the naughty step, I think, for a while, isn't it?
Yeah, and
Just
especially looking at that trend channel. So I've drawn a trend channel there too, just so that you know, it helps illustrate what we mean by, you know, if it's obeying the rules of a downtrend and it's walking that dog lower, do not try and unfollow that trend, because the trend really is your friend. It's not, it doesn't guarantee you anything.
No, but it's a good starting point, isn't
Exactly. I like to think about technicals as like having a samurai sword. So, you know, a samurai sword's not made out of one bit of steel, but lots of tiny folded steels, and just any extra from technicals just gives you that sharper edge.
it? I like it. Very
Yeah.
good.
There you go.
Very good. So
Steve-
you are Uma Thurman in Kill Bill.
Oh, I love that yellow tracksuit.
Yellow jumpsuit.
Bring it
whatever
on.
Yeah, absolutely. Yeah.
Devin Connolly saying my best ever buy, Coinbase for 33. Unfortunately, it was only £250 worth. Oh,
Stephen, you never have to tell people your position size, just the price action.
Exactly.
That's the thing with trading. There's always an angle to spin a.
Yeah. Or percentage. You can always just share the percentage.
Percentages, that's right.
Nothing wrong with that, but well done you. Well done you. Yeah, like I'm going to say my ether.
Never confess. Now, after that
30%.
concept, now, what a morning we've had. We've had Ronnie making it in. We've had some great content out of Elliot. We've got your mining speciality as well, just a moment to have. That's not worth a like and subscribe. Remember, it doesn't cost a penny.
Yeah.
There's no commitment. It just tells us that you like what we're doing.
Yeah, we're not taking your bank details, darling.
Yeah, not yet, not yet. That'll be the next iteration. But yeah, for
just
now,
like and subscribe so we can bring you more of this good stuff. John already,
For now.
and we have to say thank you to Scotty for being an absolute trooper, because if not for Scotty, you know, standing in for
My pleasure.
Rich, producer Phil and everyone, I would not be able to be out there on the emails with John to let him know what you guys want to hear about.
well, it's
Because
very good of you
what's-
to say.
It is
Unfortunately, having worked for 2 days now, I need 2 days
deserve
off,
a
so I'll be
break.
back on Friday.
Because, you know, yeah.
So
you
I
need
can't
some
overdo it.
Beauty rest time.
Absolutely. I need as much juicy sleep as possible. About a millennium's worth, I
I mean,
think.
that skin, if you think it's glowing from your laptop, you know, it's even more glowing here,
Yeah,
let me tell you.
absolutely, yeah.
All right. Stephen Conley, thank you very much. Monkey Man, saying night. Oh, he's back off to bed. Monkey Man has late nights. I hope you haven't like stayed up all night to catch this.
No, absolutely. And
Right.
thank you very much, Jugger and Pelican, to round off with. Right, you need to go and prep for your mining
Yeah, stay right there,
extravaganza.
because John Mayer is coming up next. He's already waiting on the line, and I've got all your questions that you've put through. Email me or put them in the chat, and I'll try my best to get them across the line to John. Right, stay right there.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Hey, welcome to Commodity Corner with the one, the only John May from SPH. How are you, John?
Yeah, I'm good, thanks. Nice to be back.
It's very loud. I've got surround sound of you in the studio, especially with the door open. It's triple audio coming through here. Really, really exciting. I seem to feel like every time we have you come on, it coincides with a huge deal. And this time being that deal with Anglos. I think you alluded to that potentially happening a few months back.
Yeah. Yeah, and yeah, it's a whopper of a deal. It's well,
I'm just putting up the last of Good.
as such. I think there's a lot of reasons why banks and one of the ways is to print more cash. Donald Trump tried to stop printing cash. It's with its debt, the government there. That's gold. It just carries on.
If you had to have the key
Smaller indicators that you can look at, the non-farm payrolls, which weren't so good in the States. The probability for come back to one thing, and that is the government going to print more cash? While Western countries are more, it's an interesting argument as to whether but I mean, it doesn't want to buy US treasuries, it doesn't want to pay out the US government right now. Therefore, it's political reasons down if the Fed cuts rates. So, which seems to be a sure thing right now. I mean, business in global markets compared to BRICS. Actually, BRICS nations are a very, very big, a huge part of the global economy these days. So all the time it feels like the importance of the USA is being eroded bit by bit.
Yeah, timing in. Gold here.
Yeah, we like it. It's the best growth profile in the London market. Yeah, and it came out with some fantastic results this morning. Really, really good grades. If I take a look at that, because it's it literally just came out at 7 this morning. It's really
we need some. Also, Greenland, any thoughts on that?
in Australia.
Yeah.
It was a great acquisition. In the first half, they did just under 200,000 ounces of gold and 8,500 tons of copper. So really good numbers. So yeah, I mean, nothing wrong. I don't think there's anything wrong with this as a company. I think it's the right direction. So yeah.
Yeah. And if you're watching this and looking at the chart, I was just explaining this. A lot of people look at a gap up like this is a daily chart and they get a bit concerned. But there are a lot of data points out there that have been crunched to show that actually if there's a really big gap up, statistically, this, if we're looking at data mined from the S&P, I believe, and the NASDAQ over the last decade or so, it tends to be correlated with a continuation of the trend rather than a closing of the gap. And as John mentioned earlier as well, this coincides with, of course, higher gold prices. Just very quickly as well, Monkey Man, who is one of our core here, asking if you have thoughts on Alamus Gold and Heckler.
Yeah, look, they're sensible companies. John McCluskey, I used to know many years ago, who's running that. He's very, very good at promotion in Canada. That was always his core skill. But no, look, they've got a sensible suite of assets, and both Alamos and Heckler, good mid-sized gold producers.
Silver's been going a bit crazy recently, but it's also calmed down. Let's have a quick look at that. Some questions earlier on about whether or not silver can continue its climb higher. And I know that silver tends to lag gold, but it's a lot more volatile. Thoughts on silver, John?
Yeah, there's a gold-silver ratio. I mean, we used to look at the gold-oil ratio many years ago, but now we do look at this gold-silver ratio, and it's yes, as you say, it lags a bit and then it catches up. So there are a load of investors out there who are very happy to buy silver, and okay, gold might be the first place they go to, and then silver catches up later on.
Copper prices are also holding steady after the tariff-fueled volatility that we saw after during the summer. Copper, let's have a look at that. Do you think that we might see copper head higher, or do you think with all that data that's been coming out of China that doesn't seem to paint a robust picture? Do you think that prices are going to be pressured by the Chinese data instead?
Well, we had thought that copper price would come off more after the tariff news in the States, where Trump had, they'd led everybody had this expectation that there were going to be huge tariffs on importing copper into the States, which wouldn't have been terribly good for their economy or inflation. So he actually did the sensible thing. I mean, I know it seems a bit odd for Trump to do the sensible thing, but he actually did it this time. And in fact, I don't want to be denigrating Trump, but often the diplomacy seems a little lacking. So copper didn't really do that badly, and then it's been edging its way back up towards $10,000 a ton, and the price is good given that there's so much going on in gold today. The market is remarkably robust for copper, and that says, well, okay, the export numbers out of China were not quite as high. It was 4.4% rather than 5% that was expected, and that was quite a lot lower than the previous export number of 7%. So imports were also lower. So okay, maybe there's a little bit of a slowdown going on in China, but I don't know. China has proven itself to be remarkably resilient, and what we know is they're they're really focused on connecting lots of low-cost power to manufacturing. So I mean, I wish our government would do this. I wish there was more focus on developing grid systems, developing low-cost power sources. We're talking wind farms, solar farms, nuclear power stations, hydropower stations, all the stuff that really helps an economy go forwards. If you remember, the French were very strong on nuclear power many years ago, and as a result, their economy has had enormous benefits from low-cost nuclear power for many years now. So, everybody needs to smell the coffee and get on the page there, and that means more copper one way or another.
Let's have a quick look at Anglo-Asian mining as well. I know you've got a buy rating for this.
Yeah, look, it's one of our stocks. It's we're Nomad and broker, so we know it extremely well. In fact, we've been working with Anglo-Asian for about 20 years, one way or another. And they are growing. They are a gold producer right now. Gold production hopefully going up to about 28,000 tons, so 28,000 ounces this year, and then 40,000 ounces next year. But copper production also looking to rise substantially to 10,000 tons this year and 22,000 tons next year. So look, I think when you compare the valuation of Anglo-Asian with other copper producers. For example, I was looking at something earlier. It's about a third of the valuation of some other companies. So I really think that Anglo-Asian has quite a lot of catching up with other companies in terms of from a valuation perspective.
And therefore, its price action is likely to catch up as well. Is that
It
the
should
premise?
do, yeah. Especially in this market where profits are going to get supercharged by these prices.
Yeah. And also in my very simple mind, I know a lot of you are very clever and very, complex, and, John reels off all these numbers and, ratios to me, and I'm just kind of like trying to understand it in very simple terms. Am I right in saying, John, that, with the interest rate environment, especially in the US, in this easing or even easing more than expected phase, that can only be a good thing for copper, right? It's going to be essentially cheaper for around the world for people to get their hands on copper.
Well, it depends on how you look at it, and it depends on what the reasons are for reducing interest rates. If the government is going to reduce interest rates because the economy is collapsing, then you want to sell metals. You sell the base metals because a collapsing economy means that manufacturers, traders will be selling metal back into the market. If the interest rates are being cut because you're trying to stimulate the economy to create growth in order to do better against China, for example, you're trying to outcompete other countries, then that suggests to me that interest rate cut will stimulate for power from those AI data centers is going to be enormous, and it's got to come from somewhere. And you can have wind or solar, but they're not consistent enough to give the base load that
given what's happening between Trump and China at the moment?
They know that rare earths are very important for drones and all the electric technology people are using. Ventilator machines, for example, they use with a permanent magnet. They banned the use of rare earths into as far as I remember. But of course, people who procure for these sorts of things no doubt have other ways of making sure they get their rare earths. But China is keeping a very, very tight rein on this. So, yeah, rare earth prices have come off a little bit, but I'm not sure they're going to come off that much. And the West really, really needs to develop new production. So companies like Rainbow Rare Earths, Macango, which we act as nomad and broker for.
Macango is a name I haven't heard in a long time.
Yeah, okay. Ionic in Australia. There's a bunch of these companies that are either producing rare earths or just piloting plants that I think are going to be critical for technological development in the West, and in fact for the war in Ukraine, for example. So I think the West is now developing this new pricing mechanism, which of course the Chinese will do their best to undercut. But there'll be guaranteed prices at certain levels for Western production, and that will help these guys get going. And there'll certainly be low-cost loans for these companies to expand what they're doing.
Yeah, and also bear in mind, Shrimp Fred, that the current estimate from the EIA is that China accounts for some 60% or more, I think it's just slightly above that, of rare earths produced, and far behind them are the US at 12% and Burma at 11% and Australia at 5%. And 2 years ago, whilst I was in Indonesia, there was a lot of talk about trying to get the cobalt over there that's under the ground too. So those of you, aside from rare earths, but looking at cobalt and how to invest, that's a key area to watch. Speaking of uranium as well, Pelican, just updating you on this. So uranium has had really, in terms of prices, had really stellar time last year. So there's always going to be a phase, a digestion phase, and it has picked back up recently in the last 2 to 3 weeks. Sprott Junior Uranium Miners, this is the ETF. I'm just showing you the chart here, but I have a position in the GBP one, but you can see that it's a similar trajectory there, and it's just now suddenly bounced off that 727 mark, and starting to move higher. And I had entered around July looking for the 3 bounces, and it has started to move off higher. So one last question for you, John, if I may. I hear that you have seen my incoming guest tomorrow quite recently. Have you got any highlights, or even to tease our viewers as to what my guest tomorrow, Peter Hambro, might say?
Okay. Well, Peter was a gold trader. Of course, he ran a Russian gold mining company for many, many years. He will give you a great insight on where gold is going. He's always been pretty accurate. I've known Peter for 25 years. He's one of his sons runs probably the world's largest gold fund. He's usually right on the money. So enjoy talking to Peter.
Yeah, very excited because I have not seen him for many, many years. He is a almost permanent fixture at the Resourcing Tomorrow, otherwise known, for those of you that go around those circles, known as Minds and Money before. Dear Lord, John, I'm feeling my age now. But it'd be great to have both of you on one day here live on set. It'd be great to chat with Peter again. Right, John, have a great day. We're going to have to love you and leave you because we've got Simon Popple on gold coming up next. What's your day looking like?
Well, I'm on holiday today, so I'm actually running around.
Thank you so much for joining us on your holiday.
Yeah, and I'm going to be running around a building site, which is I'm rebuilding the house that I normally live in. Following the flood of Storm Bertie.
Yes.
But I am very pleased to report the insurers did finally pay out.
Amazing.
So long as you're completely straight with them, you're not greedy, then actually, and you have to work through the process, and you do need to get professional advice, but it does work. And so they're not paying for the whole rebuilding. They're just covering the cost of the damage, but it was a good day when the insurers paid out.
Fantastic news, and everyone here on the floor as well, thanking you for your thoughts on everything from Sarabi to Greatland to uranium and also to even rare earths. What a privilege to have you on. Thank you so much, John, and we'll catch you off air later.
Thank you.
I wouldn't go all in on gold and ignore silver and platinum, or all in on silver and ignore gold and platinum. I think it's good to have a blend of all three. I'd probably have more money in gold, in silver than platinum. I think money. Yeah, very well. It's speed of travel less.
Then perhaps at area of interest at 3,516, and we have a is point higher prices. I guess the question is
market uncertainty, interest rates. Money for a few months.
from our friends of course, real possibility of
the market is expecting to flip up, but if we get anything if they hold rates, it would be no telegraph these things to the market. Yeah, it'll be a good.
You and I were last week.
Silver, silver. Now 40 graph shows that. But if you're prepared to sort of take a longer term view on silver, a few months, and try not to look at it every day because the price really does jump around.
Middle of next year. What do you think?
I wouldn't disagree with their kind of forecasts. I think the key really is the volatility, and the price can go up a lot, but it can also go down a lot, as your longer term graph has shown. So, if people are going to invest in the sector, and I mean, the thing I love about gold and silver, and but man, they're volatile, and so you do need to kind of accept that, and that's one of the reasons why I think it's good to have a bit of diversity. One of the things I love about mining companies, you could have a mining company that has found a lot more gold or silver, their costs have gone down, their production's gone up, so their share price could actually go up despite the silver price or the gold price going down. So, when you've got that volatility with gold and silver prices, having some of the miners can actually help you. So, yeah, I think it's good to have a bit of a spread.
Yeah. I've got a position in Sarabi, as most of you know. Andrew McKelvey chiming in, asking whether you have any views on Greatland Resources.
I love it. I mean, it's... I don't like to talk about particular companies, but I mean, they are, I think, Australia, Tasmania, something like that. But yeah, they... I think a lot of these companies, you need to be careful how excited you get, because obviously the top line is going up dramatically with increases in gold and silver prices. But the bottom line is going up as well in terms of, the costs, all in sustainable costs. They used to be around sort of 1,200-1,300. They're now closer to sort of 1,900. So margins are, doing pretty well by and large, but you need to look at both sides of the equation. Look at the costs as well as the revenue, because if you just look at the revenue, you probably get a bit too excited.
Also want to ask you about ETFs. Many of our friends here, asking very often, and should we look at, ETFs if we don't know each individual company? You are a big fan of not going down the ETF route, right? Just explain why.
Yeah, I mean, ETFs, they have a place, don't get me wrong. But I think that if you're looking for diversity, I would say, why don't you just buy a fund? There's some big funds out there, BlackRock and Jupiter and things like that. They've got big funds. If you're just looking to have exposure to just buy the physical. rather than any, put together. get a decent return, but then you've got your kind of your high risk stuff in your back pocket if something happens there.
Fantastic analogy,
exciting.
especially since there is the Premier League, fantasy football in play right now.
Exactly.
Yeah.
So, but yeah, I mean that's I use the same format for gold, and it's a simple way to explain, how you can try and make a lot of money from gold.
Just very quickly, because we need to wrap now, but very nice about all three. Someone kind of now looking, towards the end of the year, how should they be positioned? What sort of percentage mixture should you have in your portfolio if you wanted, obviously exposure to gold, but also platinum and silver?
Yeah, I mean, giving percentages is very difficult. I mean, what I would say is I wouldn't go all in on gold and ignore silver and platinum, or all in on silver and ignore gold and platinum. I think it's good to have a blend of all three. I'd probably have more money in gold than silver, and certainly more money in silver than platinum. So, but yeah, I mean, a lot depends on how much money people have got and they want to invest in the sector. But at the moment, I like all three. And if you've got all three, and as we said earlier, you can cope with the volatility, providing you're putting money in that you don't need to spend anytime soon, then you could have a lot of fun.
Snoozer for stocks, but not for gold or bonds. It's Monday, September 8th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Mike Butler in Chicago, here to take you through the rest of this hour as we wrap up the trading day. If you're on the platform Tasty Trade, on the website tastylive.com, thanks for joining us. Come over to YouTube. Tell us what you think of this market today. What could be the start of a slow week. There's not much by way of an economic calendar the next few days ahead of that inflation report on Thursday, although there are some bond auctions coming up this week that may draw our interest ahead and wrap around the inflation release. Not like gold and silver are waiting, which continued their extension, gold at a new all-time high here today. But stocks didn't really get the memo. Some of the tech stocks trading a little bit higher, but generally speaking, it's a market that's modest to the upside. 0.5% in the NASDAQ, 0.2% in the S&P 500. Currency space, the dollar is still getting jammed up a little bit here as those lower rates kick in. Mike, I found this to be a pretty uninspiring equity market one way or the other today. Volatility didn't move. It's still an 11.3 IVR here in ESU5. What's your give us your 2 cents here on this market as we embark upon this trading week? 80% of it left to go.
Like you said, it's been interesting for specific sectors, but on Friday, I had an overarching thesis that we will just chop until the rate cut actually happens. So I put on a 1 day. So on Friday, it was a weekend iron condor that I closed this morning. That was a nice winner, but I plan to do the same thing tomorrow. So tomorrow morning, I'll just place a 0 day iron condor. I just think until the 17th, I think we'll just get some chop until the market tells us, or I guess the Fed tells us that the market's been right. Or maybe wrong, but I looked it up today. Now we're getting a 10% probability that we've got a 50 basis point cut in 11 days.
It's
here.
12% now.
Oh, sorry. Yeah, 12%. My bad. But
it's been drifting. It's been drifting all day.
Yeah, but if I've learned one thing from you guys, a 50 basis point cut is no good, and it seems like there's a little disconnect between the equity markets that just are drifting higher and gold that's surging, which would imply maybe the markets are going to see some turmoil, and of course bonds and notes too. So what do you guys think about this? Sell-off incoming, Ilya?
I'm on the same boat as I've been since basically the beginning of August, which is the last time these stock indexes have done anything. And that's really the most interesting thing for me. I mean, if we go back to when CPI came out last time, middle of August, that was the last time that we had any kind of meaningful trend momentum for the S&P 500, say. NASDAQ hasn't even attempted to crack those highs. S&P has been a little bit more chipper. But we established a range top then. We haven't really tried to break it in any kind of consistent way, and we certainly haven't succeeded. And so my playbook has been the same since then. The market knows the cut's coming. That's not controversial. In fact, the market has been at 50 basis points, matching the Fed's stated cadence all the way back to December, at least since May. So the markets have known what the policy is for this year. The big question is next year. And next year, there's a huge disconnect between the Fed and markets. So I think the big thing from the Fed this time isn't going to be the move, unless, of course, they do decide to throw a grenade out there and make it 50 basis points immediately. I think the big question is what's going to happen next year. And there, the Fed's been saying only 25 basis points. The markets are closer to 80. So we're going to have to see some sort of movement on the summary of economic projections in a dovish direction, or I think the market gets upset. Because if you look at these dynamics and sort of the way that the S&P has behaved relative to the outlook for Fed policy through the end of next year, it's been as clear cut as you can possibly imagine. When you get the rebound in stocks from April's lows, the outlook gets, understandably, less dovish because the fear goes away. That ends by mid-May. And from there, the outlook for this year is steady. The outlook for next year is getting increasingly more dovish. We are now more dovish in aggregate than we were in May, than we were in April even, at the lows, and stocks drift higher. Could it be that this move in stocks was first, oh good, Liberation Day isn't a guarantee, but then a month later, okay, rate cuts. And if those rate cuts aren't coming in this kind of volume, that's a lot of upside momentum for stocks that all of a sudden looks mispriced. And sound.
Thanks for that. I always want to just mute the sneezes here. People don't want to listen to me sneeze, right? So we go to a market on Friday where obviously we have the big reversal coming into this week. Will we hold on to that? Will we find continuation? Or we really don't, Ilya? In a certain sense, it kind of reminds me of what happened at the start of August, where you had the big move on the Friday around the jobs data. Europe and Asia come take the baton for the start of the trading week, and they do nothing with it. And so then
they decide not to go,
Right. And then U.S. equity traders today, they push up the market a little bit after Asian and European traders, again, don't take the baton and run it to the downside. Looking at the sector performance here today, I don't think it's going to surprise anyone that the top two are GDX and GDXJ. But for the sake of equity index companies, SMH here is your top performer. Broadcom at the end of last week had a really strong performance. Today, it follows it up with a 3.26% gain. Mike, I'm looking at some of these individual companies that have been leading the charge to the upside, like your Broadcom, your NVIDIA, your Meta. Where's the volatility? I thought August and September were supposed to be the big vol months, according to my little abacus here. How do we deal with a 2.1 IVR in a stock if it's not just Broadcom, but any of these big names?
Yeah, I mean, the earnings this quarter have been pretty wild. Broadcom had earnings a couple days ago. They've had a pretty decent range over the last 2 days, but yeah, volatility's just been crushed in here. I think a lot of the implied volatility that was propping up the IV ranks is now gone, because basically, obviously after an earnings announcement, you're going to get a vol crush across the board, and the VIX is low. So I think a lot of these companies pre-earnings had decent IV ranks, but now with nothing on the horizon in terms of a binary event, you have a bunch of these equities in the 30% range, which is always going to be a low IV rank reading. So, yeah, I mean, it's tough to say whether these companies will actually find any reason to come down unless the overall market goes down with a vol pop, because the VIX right now not looking great, sitting at 15, and more importantly, the vol futures, we've got significant contango right now between the V and the X contract, and both of those are under 20 now. So it feels like the market's telling us nothing to see here, but it seems like we think that maybe this is going to be moving around, at least when the announcement actually comes out, whether they're doing 25 or 50 basis points. For whatever reason, I feel like the market's going to sell off when they do the cut. In a rare turn of events, I think I'm in line with Ilya here, that when the rate cut hits, whether it's a 25 or 50, everyone gets faked out with a nice big sell-off.
Yeah. And yeah. And I mean, I think the reason for it will be that the cut's not anything like news for anyone at this point. And if the Fed doesn't come through and say there will be many more cuts next year than we said before, even just one more, even if they go from 25 to 50 and the market's at 75, if they at least see some movement in their direction, they'll probably find a way to say, okay, fine. But if there's no movement and the commentary is we're still more concerned about inflation than employment, especially while you get signs the economy is reheating. Look at the ISMs, look at the S&P Global PMIs, the tone of data, even just looking at the Atlanta Fed GDP Now model, it wasn't updated strangely on Friday. So you can actually see it up and just ahead of Friday. GDP expectations for third quarter are not anything to be taken at face value this early in the game, but you can see the tone of the data, and the tone of the data has been positive. That's not a situation where the Fed is going to go, oh yeah, let's be ultra dovish right now. So they'll give the 25, I think, and not the 50, but the more the markets get hopped up on maybe it's 50 and it'll be 75 next year, and the Fed says, no, actually it's 25 now and 25 next year, and then there's another one here somewhere in October, December, I think the market doesn't like it.
You know, it's interesting that you talk about the Fed potentially going 50. That is an idea that we've kicked around here for several months, right? If they're going to do it, they're going to go 0 or they're going to go 50, even though the market's only saying 12% chance. I would point to the inflation expectations that have been coming off the board. You can see the downtick only slightly here, but we've had a little bit of a pullback in recent weeks where forward-looking inflation expectations are starting to come in. And the Fed's own model of where like 10-year yields should be, for example, they're suggesting they should be a bit lower from where they currently are. The point I'm getting at, though, is that if you're the Federal Reserve, you could easily make the case that looking around the corner and how, again, the NFIB charts about job expectations, right, and how the economy looks 3-6 months out, individual consumers' expectations, the rise in consumer credit card debt, by the way. Did you see that today? Consumer credit card debt jumped to $16 billion. The expectation was for it to go from 7 to 10. So people are spending
and
money.
Inflation expectations went up.
Well, you could point to enough of a decline.
Markets. Not in the markets. The survey, and that follows the U of M one that jumped. In the markets, of course, break-evens have been pretty lackluster since they bottomed in April. And this has been the market's whole logic, that the Fed is wrong to worry about inflation, that they need to worry about the growth outlook. And that's been sort of behind this shift to ultra dovish expectations for next year. The markets have been screaming at the Fed, you're worried about the wrong thing, basically for 4 months now.
Maybe. The fact that 10-year yields could be breaking below 4% this week, I think, is noteworthy. The last time we saw that, of course, was in May.
Totally.
April, right around Liberation Day. So this is a different kind of move down here, of course. It's not like a panic. But if lower rates are coming, Ilya, that does cause a problem here for our beloved US dollar, which, my exposure is Canadian dollar, euro. The euro's breaking out now.
I don't know. I mean, the only one that really looked like it broke out to me was the Swiss franc. Everything else is basically at its anti-dollar range extreme. Yes, if you put a sloped line on here, it does look like it's breaking out. But I trust sloped lines very modestly because it's all very much in the eye of the beholder.
You're horizontal, man.
That's right.
As Josh would say.
That's right. And when you look at this, you go, okay, well, we're at the top of the range. Are we actually going anywhere? The pound looks the same. The Aussie looks similar, though it's a different range top. The Canadian dollar looks probably the weakest of the bunch. The yen looks the same. The Swiss franc was really the only one that broke out higher last week in a very kind of convincing way. And this one I just got out of. Like, I was short this. I am no longer. I took a little baby loss of less than 0.5% of equity, and on we go. But everywhere else, I'm still long dollars because I don't think it's really made a move. And considering what the bond market is doing, I mean, yields are, I don't want to say crashing, but they're certainly moving lower in a hurry. And the dollar isn't breaking its ranges. It should be getting absolutely tanked, but it's not. And that, I think, is interesting. I'm not sold on the idea that the dollar is done bottoming here.
Well, I mean, you look at the positioning data right now in the market, Mike. I mean, I see a market that's still very short the US dollar. Surveys show that it's still the most hated trade by institutional investors, being long the dollar rate. Most everyone is the favored short trade of the year so far has been dollars and remains US dollars, according to Bank of America's fund manager survey. But I see some higher volatilities in the space, particularly in the futures options here. Maybe not in Tasty FX world, but at least here on Tasty Trade world. An 88.6 IVR in the Canadian dollar, the euro, which is way more liquid, still up at 36.1. Why not sprinkle in something like a directionally neutral, what have you, at 60 days out right now, Mike, and try to play for some more chop, even if maybe give some room to the upside if the dollar's breaking. These are pretty decent risk to rewards, risking a little bit less than 8 to make 4.5. That's better than a 2-to-1.
Yeah, I like the neutral trades when it feels like the markets are waiting for something to happen or a decision to be made. It feels better to place for sure. I'm long the US dollar, for better or worse, but it's like really small. So I just use the Tasty FX products. We just look at daily ranges, and we place some short euro dollar position, a long dollar yen, a long dollar franc. But those positions are so small that they won't really be meaningful anyways until they move in our favor if they do. But yeah, I think when you have this period of time, which we're in now, that basically suggests that the markets aren't moving anywhere or anywhere substantially until September 17th. I think a lot of these markets will kind of have a wait and see approach. But the big move to the upside, the huge bid in gold, I think is really interesting and maybe a little telling of what we can expect. I feel like the move in gold, unless I'm missing something drastically, I feel like the move in gold is more of a, we're not sure how the market's going to react to whatever's going to happen on the 17th. Let's just get into something that could see more upside if there is going to be more turbulence in these markets. But SPX implied volatility through September 17th is only 90 points. So that's a really narrow range for 9 days, in my opinion, with such a question mark still on the table. I feel like at this point we should be looking at what we were looking at last week, where you had a 98% chance of a 25 basis point cut, and now there's more uncertainty being baked in on the other side of the curve.
It's really interesting that you mentioned that about the only 90 points, though. Like, we're talking about under 1.5% trading range until next Wednesday Fed meeting.
Yeah.
You can see the jump up here. It's like 7 points, 5 points, 8 points, 4 points, right? The market's pricing in barely anything additional around the Fed itself the day of.
Yeah.
It's kind of wild.
It is wild. But these like this, if there's a time, I'm going to put this money where my mouth is here. If there's a time to do like the 0-day neutral iron condors, I think this is an interesting time, because if it does pan out that way, where we just see really narrow ranges and low volume, the 0-day iron condors should be okay. So we'll be back in tomorrow.
Yeah, let's just put that up on the screen here real quick. So we want to do 1 DTE for this. I guess we're going to go to 0 if it automatically places us there. No, you're not helping me. So we'll just do it ourselves manually. We're going to go over to the 1s, Mike, because that would be tomorrow's expiry. The expected move, small, talking about 25.5 points on either end. So just straddling the 1 standard deviation expected move. If people wanted to do what Mike does, be like Mike. That was a thing from the 90s. 62% probability of profit, risking 3 to make 1. 130 gain, 370 loss, buying power 370. It's just expecting the market to do nothing until we get a reason to do something.
Yeah. So I did this on Friday. I had a similar max profit, max loss. I got $1.90 because I had the weekend risk in there. But we were sitting at, my short option was at 6,500 today. We were sitting right there, and then we got a little bit of a sell-off intraday, and it went from a scratch to a $100 winner. So just make sure if you're doing this, you have your GTC order in to capture some profit, because it can happen quickly if you get a tiny move over the course of 5 minutes.
Mike, I like this. Let's just get this on the board so it can start working and send it in the next session. But yeah, this makes a great deal of sense to me. Tomorrow, Ilya, I don't see anything on the calendar that's going to meaningfully move us. Sure, there's something that could happen out of DC, but there's always something happening out of DC. It's become so much background noise for the market at this point in time. I could probably point to 4 or 5 news stories today that a decade ago we may have seen market movement on. So what's
tomorrow? By the way, the annual
note auction
revision for the annual revision for NFP comes out.
Yes, that's the one that last summer when it came out, we heard that it was proof that the prior administration was fudging jobs numbers to prop up ahead of the election. Okay, so like this is then something that's interesting for the market. What was it last year? Minus 818,000 jobs.
Minus 818 last year. Obviously, that was a huge revision. I don't know if we can even say that that's such a huge revision this time, considering not this past NFP, which was only revised down by 21,000, which, by the way, that's a fun thing. You get a 22K rise in jobs, and the previous months were revised down by 21,000. So what, you added 1,000 jobs? That's nice. But anyway, the preceding month had a revision of 258,000 just for the month. Now, that's a big revision, and it's spread over a couple months of prior revised data, but you figure there's at least some kind of a level of acclimation in the markets to these big triple-digit numbers. I mean, if we get the annual revision here and it's, let's say, bigger than it was last year, let's say it's approaching 1 million jobs, let's say it's more, is anybody going to be that shocked? I'm not sure. I doubt it. The PPI numbers on Wednesday, though, that might be something because it comes out before CPI this time. Last month, it was the other way around. And this is where you've seen the tariff inflation really start to show. So if you get a sense ahead of CPI that more and more of these prices are getting passed through from the beginning of the supply chain down and towards retail, that's going to be interesting stage setting for CPI on Thursday.
Could be interesting stage setting for CPI on Thursday. We had we have CPI and PPI that came out last month. Ilya, they pointed to inflation that could be closer to 0.5%.
Yeah,
just
PPI especially because
yeah,
where businesses before basically last month were eating the tariff costs and saying, okay, let's not kill demand. this thing is, let's say, vague enough that we don't want to front run, they threw in the towel in July and basically said, okay, you know what? We're building our margins back out. You all pay for this. We're not going to do it.
Everyone's doing it. Even that lovely little Asian market in South Park, Colorado, Mike. Everything can be blamed for tariffs these days. I don't know if you saw the most recent South Park episode.
I need to check it out.
It's all about Labubus, which is just a terrible thing to have in your child's life.
The little like rat looking things. Yeah.
Yeah, my daughter got on that too a few weeks ago.
Mine too.
Yeah. There's a pharmacy in town that's selling them for $60 a pop.
Well, you know how everyone's
my
obsessed
daughter
with
is content to watching them on YouTube and then sketching them.
Oh,
you know the
smarter.
little gotchas, the little vending machine twister things? Yeah, you know. McDonald's just made little gotchas. So that's a genius marketing. Like that's when you know the pulse of society, when you've got McDonald's putting out little gotchas of like cash registers and soda machines. This is where we're at.
They're bringing gambling from mobile apps into the real life.
Yeah.
Where it's like spend $99 and get this mystery box.
Yeah.
And you're like, ooh,
they opened
mystery
a
box.
shiny new arcade in one of the malls here, and an entire section of this arcade is dedicated to mystery box.
Yeah.
Machines of various size, stripe, and cost.
Yeah. They're everywhere.
Can we get that on the platform? PMRTY? Yeah. Pop Mart. Look what you've done this year. This is a Labubu company. Started the year near $12, now up at 37.
Classic.
PMRTY, Pop Market International Groups. It's the ADR. I digress from childhood consumption issues. So we have a market that's pinned, volatility even here after hours coming in a little bit. Top performers in terms of today. We were talking about SMH before, and then of course what was happening with GDX and GDXJ. But that's not the only thing that's happening in this market. I couldn't help but notice that XLU is coming in. Okay. Utilities have been a bellwether for the broader AI trade. Issues around electricity generation in the United States have been drawing a lot of attention over recent weeks, in part because there is a meaningful impact in inflation from these higher electricity costs. And so a lot of folks are coming out against it. I saw that not only are we watching XLU come in, but I got this great chart earlier today from Torsten Slok over at Apollo Global Management. AI adoption rates for larger firms starting to decline. It looks like we may be flatlining a little bit here. Mike, before Ilya says this is the adoption of the railroads in the late 19th century,
the Economist did a whole story about it this week.
My blood pressure's going up.
Telephones and whatnot.
Is this the new headwind for the space, Mike? That like AI is not delivering real results and real productivity boom, and we've all just been buying castles in the sky. Meta is 20% of NVIDIA's business right now. So if big firms are not adopting as quickly, isn't that a problem for the chip makers? Today's top performer?
I think we're in an interesting spot. I mean, we've seen firsthand how powerful AI can be, even on the tastylive network and at Taste Trade too. But yeah, I think the initial shock, it kind of reminds me of like a Tesla, where Tesla was talking about doing X, Y, and Z, and the stock was just mooning. And now it's like can't buy a bid because of everything going on there. But every story has its little I don't want to say bubble now, but every story that is just pure euphoria has its kind of bottoming out. Maybe eventually we just keep skyrocketing, but I think there's definitely some issues at hand in terms of the scalability of the immediate impact it can have. Like, of course, everyone can have an AI agent that helps their support team do X, Y, and Z and automate everything.
I tell you what I've had an AI agent doing. I created a custom email address just to test this out in, and I have it, and I gave it to two people, the email address. Like, hey, I switched my email address. And I set up a bot there to respond to them at random intervals to let them know that I'm thinking about what they emailed me about, but I don't have an answer yet. And I forgot to to set a limiter on it when I first set it up. So when I went in there the other day to like take a look at the conversations, I had emailed one of my friends 18 times in the span of like 7 hours to let him know that I didn't have an answer for him.
My God. That's amazing.
And I only found out because he gave me a call and he's like, I need to know what the plans are. Like, what are you talking about?
You're emailing me every 30 minutes saying you don't know still.
Nope,
I'm like,
still
okay,
don't know.
so
Nope, still
that
don't
new
know.
email,
Nope.
you may have been a guinea pig. I love you, bro.
That's incredible.
So we're experimenting around here.
Yeah. I think AI will change the face of a lot of the things that we see now or have seen in the past. But I think it's a kind of a similar story to crypto. Like the power of crypto isn't necessarily just buying Bitcoin and forgetting about it. It's kind of changing the way that things are processed under the hood. Stablecoin funding. Like the fact that you can fund your Tasty account with stablecoin now allows international traders to bypass some of the international wire fees, and you get your buying power immediately, et cetera, et cetera. So it's like those kinds of things are, I think, going to be more impactful from a crypto standpoint. Just like AI, there's going to be things in AI that we don't necessarily understand yet that are going to be embedded in a lot of these companies' infrastructures. And, maybe that's it. We're in a figuring it out stage.
Well, the good news is that we did pass the Judgment Day anniversary. Skynet goes live on August 29th in that future, whatever it was. Now, granted, it was 1997, but still, nevertheless. You mentioned the cryptos, though, here, Mike. I do want to delve into this a little bit more. What's happening with the crypto space now? I've seen a lot of depressing feeds from people selling their Bored Ape Yacht Club JPEGs in recent days at massive losses. This is not something that happens when sentiment in the market is very high. And it makes me think that we're actually been in a little bit more of a drawdown here. Ilya, I know that you don't think the space is any sort of legitimate, but for those people who don't like, we don't like gotcha boxes, Mike, but we will play with crypto.
Yeah.
What's going on in the space right now? It feels like this is, maybe the chat has an opinion on this. Chat, you tell me, does it feel like something's off in crypto world right now, that vibes are bad? Because that's my read on it.
Vibes are not necessarily great, but I think one of the things that we've focused on specifically when we've had Ryan Grace from the Tasty Crypto team on every Monday. He's out on paternity leave, so congrats to him. But one of the things that we focused on was the Bitcoin dominance ratio. So Bitcoin dominance was super high 6 months ago, and everyone investing new flows was basically going to Bitcoin. This was all the while Ethereum was down at like 1,500, 1,600. And the trade was, if you believe that Bitcoin dominance is going to come down, where are the funds going to go to? Products like Ethereum, products like Solana. So we were talking about this Ethereum trade. I mean, it came to fruition way quicker than we may have imagined. But when you look at crypto as a holistic entity, there are certainly trades within that if you dig into it. So it's still funny though. Like we're talking about how Bitcoin feels like it's dead, blah, blah, blah. It's still at 120, 112K. And someone in the YouTube chat,
Mike.
Oh yeah.
Might as well be zero.
Yeah. Someone in the YouTube chat actually said, I forget where it was. Let me see if I can find it. It was something along the lines of, I think we will see interest rate cut hit, markets will drop, and gold and crypto will go up. So do you think that crypto could be a haven for equity funds that are leaving the equity space going to gold crypto?
Elliot, can I make a point before you jump in here?
I have a one-word answer.
Yeah, he just says say no. You can say
I know he's going to say no.
Simple answer is no.
I know.
Stop it.
Okay, so in terms of economic forecasting, you and I have touched on this a little bit, but now I'm blanking on his name, but Goldman Sachs chief economist was just won a distinguished award for his accuracy and predictions over the past 2 decades. He called the global financial crisis in 2008. He called the post-COVID market to a T. Okay. He pointed out that he just tracks the business cycle. So let's just simplify this for everyone here. Where are we at in the business cycle right now on monetary policy? Monetary policy looks like it's going to get looser, expansionary. Fiscal policy is expansionary. maybe not for the 80% of the population, but for the top 20% that play around in the stock market and financial assets, it's certainly expansionary. Is that just the story we need to know, that monetary conditions are loose, that fiscal conditions are relatively loose, and deficits going up with low rates tends to be asset inflationary? I mean, like, why overthink this? In the spirit of a Dylan Radigan who's not here, why think at all?
Because I think we know all of these things, and this is what we've been looking at since, again, about mid-May. And so there's nothing here that needs to be priced in further. Unless, of course, the Fed decides to go the market's way. Now we have to find out whether the Fed is going to get off this inflation is our greatest fear thing and tell us next week that they're going to go the market's way on rate cuts next year. Then you have some validation. Otherwise, we're priced for it. Since mid-May, we've been at 50 basis points, give or take a few here or there, depending on what's going on in the markets for this year. The Fed told us that was going to be it since December, before the tariffs appeared, before the new administration even got into office. So that's non-controversial. The markets have been going up for certainly a combination of reasons, but one of the big reasons the markets have been going up is the markets, again, since mid-May, have increasingly diverged from Fed forecasting. The markets have gone more dovish. The Fed has gone less dovish for what happens after this year. The Fed revised in June from 50 basis points to 25. The markets revised over the same period. And now, because they've continued moving, the Fed's stopped all the way out to almost 80 basis points. So we are now at a more dovish outlook for this year and next year than we were at the absolute maximum pain point in April, and this year hasn't really moved. It's all next year. So sure, I mean, don't overthink it, just don't assume the markets are going to think this same thought in perpetuity. At some point, things do get priced in. And they've been, at this point, so priced in that the markets are now meaningfully decoupled from what the Fed is saying to the tune of at least 50 basis points. So if the Fed doesn't deliver, now there's scope for disappointment. And as far as fiscal policy, what loose fiscal policy? The president is out here touting this many $1 trillion in tariffs. That's a tax hike. What
we have 17
policy? Where
we have $17 trillion coming into the country, Elia.
It's 17 now.
Oh, 17 over the weekend. Yeah.
Why not just go the 20? Give us a number with a zero at the end of it.
That's too, Mike, if he's like, oh yeah, we raised exactly $20 trillion from tariffs, would that be believable? No, 17 trillion is a much more believable number, right? $17 trillion.
It's got to be 17.3 then to really nail.
That would convince me.
Yeah, I would be sold then. But I mean, what are we looking at? What expansive fiscal policy are we looking at? We extended tax cuts that already existed. No stimulus there. And we've introduced a giant consumption tax.
Well, there are more tax cuts coming for the upper income deciles for sure.
But they're not spenders.
You and I have talked about this. Like, we're both getting tax cuts from this
because we got SALT reconsidered in the big beautiful bill.
So we're going to give California. We're going to give Californians, New Yorkers, people from Connecticut, New Jersey, Massachusetts,
homeowners specifically.
Okay, wealthy homeowners in rich states more money to spend. Right. What are they going to do with it?
They're not going to spend it.
Do you think they might put it in the stock market or gold?
Crypto, baby, Bitcoin.
So I'm saying, like, where does the money go? What are you said this to me earlier? Water always finds a level. Capital's like water in the global financial system.
That's right. Always finds a level.
Where's the level? Do you think that we should be investing in treasuries with the 10-year note at 4.05%. Is that enough?
I mean,
of a premium?
it seems like it's found a level, which is why you have now this disparity between the markets and the Fed. And the question is, did the Fed get religion between June and now? And you look at the FOMC minutes, you look at what Powell was saying, and the answer is no.
They didn't get religion. But hey, recession might be coming because when gold and bonds fly, that's usually what it means.
Yeah.
Right? Post non-farm payrolls would have been the two best performing asset classes. CB, GC.
Well, and you load up consumers with a giant consumption tax. They're going to be so excited about consuming. We already had the first 6 months of this year give us the weakest consumption since the quarter that was the onset of COVID, the first 6 months of 2020. Like, that's already occurred. And in related news, as it were, at the end of all of this, this week, we're going to get the University of Michigan consumer confidence data. Never mind the consumer confidence. It's already going down significantly. But more importantly, inflation expectations. They're rising again. They jumped back up to 4.8% in the last set of numbers. If the PPI numbers are telling us anything, it is that is only going to go higher. So we have an economy that, at the very least, is hampered by the fact that 68% of it is household consumption, and they have to pull a giant tax hike now, which is what these tariffs are.
Yeah, there's this chart I saw mocked up on Twitter earlier. It comes from Amanda, just make sure I get her name right, Amanda Goodall at the Jobnik. Don't know anything about her, obviously. Shares are not endorsements, but charts like this are. Credit card usage, revolving debt in the most recent report was up 9.7%. Debts otherwise are not really moving. And what have been the most recent interest rates for those debts that are rising? In the 20s. Okay, this is a big problem for people. Americans like to fund their lifestyles, and they continue to spend the money to keep the lifestyles afloat. We saw this in the Vibe session, Ilya, in 2022. Yeah. Right? Everyone was miserable, but no one wants to give up the sense of feeling that they developed during COVID when they were getting stimmy checks and working from home and conspicuously consuming and ordering everything to their house, right? Like, how used did we get to, private taxis for our burritos, as the saying goes? And people may be losing their jobs and employment slowing down, but people are still spending the money. So, when do we run into that wall? Maybe it's another data point why we need a rate cut, although ratcheting of the interest rates doesn't help on the way down the way it does on the way up. Credit card companies aren't that lenient with giving you better rates very quickly. I don't know, guys. I walk away from this. Interest rates are low, so where are you going to put your marginal dollar? I feel like a total jagweed, Ilya, for not being on gold for the last $80. At least not through the options, because you know how much fun I have through them. Or is this just going to be a march higher now?
I'm still sitting long, and it's working and good.
And don't touch it. And don't make my mistake. Don't make my mistake.
I got tons of duration left in it. I'm not going to mess with this. It seems like it has done something that isn't necessarily even motivated by the Fed or rates. Only Friday did the bonds sort of start to validate this. Gold obviously started this move much earlier. And so, and the dollar, again, weak on Friday, a little bit more today, here and there, but again, not breaking any ranges for the most part. So this seems different. I think Mike said it earlier. It's more so a reflection of increased uncertainty than it is sort of defined risk aversion or defined policy outlook. It's more like, you know what, let's allocate more this way because there's a bunch of touch points ahead and who knows what happens now. In part, I think you turn to these Supreme Court cases looming and you go, okay, is it possible that after we've spent basically 5 months figuring out that the tariffs are going to be this or that, and sentiment recovering from that, what would it do if all of a sudden now the lower court decision was upheld at the Supreme Court or even kicked back, and the Supreme Court said, you know what, we're just not going to take this up, and the whole thing ends up being illegal, and most of the tariffs just fall apart. And then we have to pay back, what, about 200 million? Sorry, 17 trillion. Wait, what? What was that number? Whatever. But we have to refund all of this money. It's just a ton of uncertainty. And I think that's what gold is responding to here. I don't see any reason to overthink this one whatsoever.
Global GDP is like 85, 90 trillion dollars from the most recent data that I've seen, Ilya.
Yeah.
So other countries are gonna just lob off 20% of global GDP and shunt it into the US economy over the next few years.
We're not going to have an inflation problem, even if that works, because magic fairy dust will fall from the sky and zap all the inflation on contact.
I don't know. This all just, you know where I stand on this, Ilya, from day one. So the fact that we're now going to like this now publicly, patently, absurdly just make up the numbers to convince people of a narrative kind of thing.
Yeah.
Hey, gold and Bitcoin still seem great from that point of view. Right.
Well, that's the whole thing, is not Bitcoin, because gold is surging and Bitcoin's not. In fact, it broke its range and it's coming down. So I've got a nice spread going de facto here. I've got a nice put vertical on IBIT, because you can trade short Bitcoin now with the right vehicle and not go crazy on the size. It's 4.5 to 1 risk reward in there if you want to take the short side. Very, very attractive.
You're doing the Peter Schiff. You're doing the Peter Schiff. Long
Basically.
gold, short Bitcoin.
Essentially.
I see.
That might be the first time Peter Schiff and I have agreed on anything.
Well, he's been short Bitcoin this entire time. So whenever you get long gold, you and him are in the same boat, I guess.
I mean, this is the first time I've been short Bitcoin or had any exposure to Bitcoin at all.
Mike, have you ever seen Peter Schiff and Ilya in the same room at the same time?
No, but it would probably be just popcorn-inducing entertainment.
I think they might be the same person.
Just get the conversation started on the Fed. You'll find out very quickly the distinction between the two.
All right, Mike, we got 10 minutes left here. To me, this is I don't want to say it's a dull market today, but it's kind of a dull market today. You get some more directional moves in the metals, which obviously is nice if you're long them. I'm still leaning long silver, been sitting on those $42 calls for several weeks now. There's still 40 odd days to expiration in here, 50 days to expiration in here. So there's really no reason to even look at it yet, as long as the line continues to go up. That's probably the best trade I have on the board right now, next to the directionally short crude oil, just expecting more chop around this like 63, 64 area. I've had some things that haven't worked. My Friday reverse iron fly mismanaged. I always say I'm a bad scalper, and it's because we touched the high of the fly, then we touched the low, and I couldn't make any money on it apparently. So sticking with what's working for me has been long metals, has been directionally neutral energy. Going to keep pressing those levers this week. Mike, what's been working for you, and what will you do less of perhaps in the days ahead?
What's
aside from the SPX Condor, of course.
Yeah. Those have been nice. Those have been great. But what's working for me right now? So 3 trades I closed this morning for profits were all related to buying the dip. So actually, Delta Airlines was a strangle. That was just a neutral trade. Rocket Labs, RKLB, that was just a high implied volatility. We call it the stupid. It's where you sell a put to finance a long call spread and you route it for a credit.
Yeah.
So you're
the
basically
double bull.
Yeah. So you're shifting your short put premium max profit to a debit spread max profit, but still routing it for credit. Microsoft, that was a nice trade. It was down like 13, 14 points on Friday. So I bought a call diagonal spread, long the 500, short the 510, October, September. That was like $130. But really what's the best trade I've had all year is just having short premium on in IBIT. So to Ilya's point, whether you're bullish or bearish, this product still moves and it still has an implied volatility. Even though IV rank is low, it still has an implied volatility of around 50 in the October-November cycles. So I've had a strangle on all year in here. Started with a $500 credit. I've worked it up to a $2,300 credit, and it's marked at $400. So this is a $2,000 winner right now. With $2,350 in credit, I have a 65-75 strangle in October, which brings my break evens down to like 40 and up to 90. So unless something insane happens, this is going to be a great trade. But every time I roll, because it has high implied volatility, you get $1.50 or $2 each time you roll. So this is something I'll probably do into perpetuity. My whole thing is I don't want to have short delta in here, unlike Ilya. So if we get tested on the upside, instead of just rolling the put up, I just shift the whole thing up so that my short call tested becomes my short put tested. And that way you kind of just inverse your delta. And it's been a really powerful strategy. I think it's something that I've been talking about. Like if I had a couple $1 million, I would just sell a put in SPX or a couple puts in SPX and just have that be the core position. But kind of this strangle is really nice when you shift it higher, so you're not worried about having short delta in a market that's just grinding higher. But yeah, that's been the best trade I've had all year, is this IBIT strangle for sure.
It's a great idea.
It's well executed. I mean, Mike, you've been harping on me about like, oh, and I hear this from Nick too, directionally neutral in gold and Bitcoin since like May. And I've been some fool taking upside shots in here and like getting ever so close to grabbing that sun and it melting out of my fingertips and falling back to earth every time. So yeah, I'm still leaning long. This to me is the line in the sand, Ilya, for what it's worth. Right, we're kind of pinned up against that May high. We're hugging the low that we had in early August.
That's basically where I sold on the idea that there's a range break here and maybe we'll get some extension. So we'll see if it breaks.
Well, that's the story here.
Back into that range, then my trade's wrong and I'll get out.
Yeah, no, this is the thing. Like if we don't break back into the range here, then it's good night nurse for me. And I holding out hope. Downtrend broken. Maybe this is a little wedge in here, right? Fun with technical analysis, drawing shapes, right? There's your wedge, starting to break out of it. We need to get through 64.5 tomorrow in IBIT. So I suppose in the BTC world, right? What would give us confidence in the upside? Get us back through 14,000 and then start to try to close that gap. This is a stupid gap, by the way. This was a stupid sell-off, by the way. Do you know why this sell-off happened? Here on the 13th of August, going into the 14th, it was announced that the Trump administration would not be revaluing the gold in Fort Knox to use the official markup proceeds to then fund a Bitcoin strategic reserve. And we wouldn't be taking out any debt to fund a Bitcoin strategic reserve. We would be using whatever Bitcoin we confiscate and we would be warehousing that effectively. Those would be our strategic reserves for Bitcoin. So the government's not going to spend an additional dollar you're issuing debt to buy Bitcoin. Okay, so there's a sell-off here. The market's a little disappointed. Uncle Sam's not opening up the purse. When does that wash out? I mean, this is as good of a place as ever for it to wash out for me, near 110. The highs that you have in December and January of last year, where we run into the rally in May, right? This seems like classic resistance turn support. If it is, it's time to prove it.
Right. And if you look at it, you can see that from April through to now, this looks more like the S&P or the NASDAQ than it does gold. So any kind of sort of thematic conversation about this is anti-fiat store of value, stop that. Just look at it. Just eyeball it with the naked eye. What does that look like to you? Does that look like the gold chart, or does it look like a chart of the S&P 500 or the NASDAQ? It's not rocket science, folks.
Looks like something that's about to rocket ship. Looks like it's coiling, ready to blast off to 150.
Or down. We'll see.
Or down. That's true.
Or down. We'll see. It does look like it's coiling. I think the step down through its range bottom that it took last week may be the start of something. And if it's not, then we'll find out soon enough. In which case, I'm going to get myself out of this position. But when the risk reward is 4.5 to 1, where you get to risk $200 to make almost a G, I'll take that punt. Sure.
I got a different punt for you, Mike. If we close above 64.5 tomorrow in IBIT, that means we're going to be through 114K in BTC. That sets us up, in my view, for a move back up to 125K. The equivalent there is basically 70 in IBIT. And thinking out the, structuring trades like this, risking 8 to make 400, so like 5 to 1, kind of in that neighborhood, close to it. That's the kind of upside shot I'd be willing to take in Bitcoin. If we can start to close the gap after this whole disappointment that the government's not going to send us tendies, as I saw on Reddit in August. I'm selling my Bitcoin because the government's not going to be propping it up officially. Okay, well, that was a good trade if you did it back then. But that's not is that why Bitcoin's been going up over the past year, 3 years, 5 years, 10 years? Because people think the governments are going to print debt to buy Bitcoin? I've never heard that argument.
For excuses. Now we're just
that's just
for excuses.
You're just making things up if that's what we really were basing our bullish thesis on. Okay,
so the whole thing was supposed to be the government isn't involved. That was kind of the whole essence of what this was going to revolutionize. How far?
I don't know about that. That's not my read on it. I watched this documentary a few years ago.
Not my read on it either, but that was sort of the cyberpunk conception. The people that invented this thing.
This is a long documentary. It's worth the watch. I swear by it. It's not a personal endorsement. I don't know the people who made it, but it's from Folding Ideas. It's called Line Goes Up, The Problem with NFTs. It's a 2.5 hour documentary. It's been viewed 17 million times on YouTube, so it's not like a little niche thing. And it talks about the origin and genesis of crypto. And one of the things that stuck out to me was when you look at the early conversations in the Bitcoin chat groups from the 2009 era, it was really all about hey, the banking system crushed us. Wouldn't it be better if we had our own system that we were in charge of? So we want to wear the boot. We don't want the boot on our neck. We want to be the people wearing the boot.
Exactly.
Fascinating.
This whole thing was anti-establishment in its conception. And now we're praying that the government is going to put a bid under the market.
How about this, though? How about if we get, so over the next 9 days, up until the 17th, if we get a move from Bitcoin from 112 up to 120 and we see gold continue higher, to me, that just screams whatever they do on the 17th, the market's going to sell off.
Oh, yeah. Stocks are going to get clanked 2%, 3% loss easily.
Yeah.
But
yeah.
Hey, time will tell. And until that point, I will be selling 1 day or 0 day iron condors.
Mike, with that, I'm in line with you.
You're a wiser man than me, sir.
I'm in there with you for tomorrow, which I suppose is a good time as ever to say with that, overtime is out of time. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I'm in Chris Vecchio in New York. Good luck trading. Don't go anywhere, though. Tasty Live at Night coming right back at you, starting with, Ilya, Macro Money up next.
See you there, everybody. Well, it was a quiet start for the markets on the first trading session after that very disappointing jobs report on Friday. We don't ultimately go very far, at least as it touches the stock market. S&P 500 kind of idling here, a little bit higher, but ultimately not going anywhere relative to where it closed on Friday. A little bit of a nudge up for the NASDAQ as well, but also well within its familiar range. A lot more of a fireworks display still ongoing in gold and the bond market. So what are we going to do this week with the Fed looming just a week and a half from now? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we have no shortage of meaningful event risk that's on the board this week that can very potently influence expectations for what happens when the Fed does finally pull the trigger. So, is this going to be the calm before the storm? Maybe so. And by the way, that storm can be bullish, it can be bearish. We just know that the 17th is a major touch point for these markets one way or another. But will we have a sort of period of drift before? Well, maybe not, because the assortment on the calendar this week is, let us say, non-negligible. First, here's how we fared last week. We can see stocks still relatively listless, 0.3% gain after a 0.2% decline. Not really going anywhere on the S&P. NASDAQ had a little bit of a better week, up 1%, but still within familiar range bounds. A much more spirited performance in the bond market, yields cratering, down 3.7% in the 10-year, down 3.1% in the 2-year. Most of that happening courtesy of the U.S. jobs report, which we'll get to in just one moment. Crude oil still kind of doing its own thing, down 3.3% last week, but that's after an upswing the prior week and still kind of idling near the midpoint of its longer-term multi-month range, going all the way back to the middle of last year or so. So kind of off and away by itself, crude oil. Gold higher, again, 3.9% last week. The dollar, though, interestingly, holding up relatively well. Down only 0.1% against the euro, for all of Friday's fireworks, and up a little bit against the yen, 0.4%. Bitcoin up 2.9% last week in all, but that's after a 6.9% drop. So over a 2-week period here, we get a large sell-off and a small rebound to retrace, but certainly the mood in Bitcoin still looking relatively heavy. Here's what we saw on Friday, thanks to that jobs report. S&P 500 down a little bit, 0.3%. NASDAQ flat. Yields taking a big hit. And, of course, we can see where those big weekly declines come from. Obviously, we can see that the lion's share of those moves seem to be on Friday. We likewise get a very convincing rise in gold again. The dollar is down 0.6% against the euro, 0.7 against the yen. Bitcoin gets most of its gains on Friday for the week, and the dollar would have had an up week across the board if not for these setbacks. So what happened with this jobs data? Well, we can see here that the headline number was vastly lower than expected. Only 22,000 jobs added, which is a pittance. 75K was the expectation, so it was already low, and now we've really undershot. The revisions were netting out to down 21K for the preceding month. So what have we learned here? Ostensibly that we added 1,000 net jobs in the latest iteration of the figures, which of course is not encouraging in the slightest. And the jobless rate in line, as expected, 4.3%, still relatively low by historical standards, but also the highest since 2021. So that much came in as anticipated, but that headline payrolls number clearly caught the markets in a tizzy, and we had first the markets jumping to celebrate that this would mean that more rate cuts are coming. The S&P initially rallied, then selling off, and ultimately, as we can see here, ending the day with a small loss, whereas it had been a large one earlier. Markets apparently don't think that 1,000 net jobs added in a given month is a good thing, or 22K even isn't a good thing. Shock of shocks. This starts the smack of recession risk, and so the markets are displeased. Now, we talked all of last week about how U.S. economic data has actually tended to surprise on the upside recently. Certainly the ISM numbers were a case in point, as were, for the most part, the other kind of contemporaneous indicators. And so we get this jobs report that's clearly on the weak side. Maybe what we're looking at is delay in sort of the usual way that jobs data tends to be lagged. Maybe we're looking at a kind of pickup in activity that hasn't spilled over into the labor market. We've heard the Fed talk about how the labor market is in a kind of strange state here, where there's not really aggressive firings, nor is there meaningful hiring. We're in a kind of equilibrium approaching situation where there's not demand for new hiring that's really powering a strong increase in payrolls, nor is there a shedding of labor forces. And so there's almost a kind of standstill. And this data would start to show us that, especially over the past 3 months or so. Not encouraging, but certainly not anything that necessarily tells stock markets this or that thing. And ultimately it looks like that's why you get, despite a relatively strong showing for a bunch of other sort of Fed adjacent assets, obviously a strong showing for bonds, a strong showing for gold, a strong showing for currencies not named US dollar. That's why you seem to get this kind of soggy thing for stock markets on the whole. What's interesting then is that, at least on the rate side, the markets have clearly taken the hint. You can see now the likelihood that we don't get a cut is non-existent at this point, even a minor likelihood for next week's meeting. We're looking at a significant level of conviction at this point that there's going to be one cut, 88.2%. That there will be a cut of any kind is now a 100% likelihood, because there's now an almost 12% chance that we're going to get a 50 basis point cut this go around. Now, this much is probably non-controversial, at least that there's going to be some kind of a cut and that it's likely to be a 25 basis point cut. Markets have known this for quite some time at this point. Moreover, we can see that the way the markets are now setting up for this year and next, if anything, they're a little bit out on a ledge for next year now, having been essentially anchored around 50 basis points here since about the middle of May. Now we're slightly in the direction of a possible third rate cut this year. We've baked in 13 basis points out of that extra move from 50 up to 75. So about half of that move is now in the market. So we're basically saying, okay, we're about 50-50 chance on a third cut. But we've been at similar levels here, so it's not unheard of within this sort of range. But the Fed has been saying since December of last year that they're looking for 50 basis points this year. And we can see that the market has basically been anchored around that level, give or take some fuzz this or that way, since mid-May. Why is this significant? Well, we can see that at the beginning of the year, stock markets sold off and the Fed outlook got more dovish as we had this tariff rollout fuel concerns about economic growth. And we can see that right here. So this is a fear about the economy. In the dark line here is the S&P 500. Everything is going down at the same time. Now, you notice in early April, this is where you get Liberation Day and markets freak out. The president then comes out and goes, whoa, 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 90-day pause. The markets have gotten, quote unquote, yippee. And so the markets go, oh, okay, so I guess the White House is amenable to market discipline. I guess it does adjust what it thinks when the markets go haywire and signal you're doing the wrong thing. And so there is a sort of sentiment recovery. And you can see we come off the most dovish extremes here. Stocks do as well. And that takes us right into the middle of May. And this is where we get back to baseline. 50 basis points, as the Fed would have signaled it. Moreover, on stocks, we come back to the site of the break. So if this right here was the consolidation range near the top at the beginning of the year, and the break from that was somewhere around here, we'll look at where we come back to being just as we get this recovery here. And so what is that saying? Well, it seems to imply that whatever follows thereafter, once we get here, is no longer about an improving economic outlook or certainly a diffusing of the need for easing. Because we can see here for this calendar 2025, the markets basically return to where the Fed was at the beginning of the year. 50 basis points. This is where we started. This is what the Fed signaled in December. It's where the markets were before this move. It's where they come back to. But notice what happens thereafter. From there, it's the outlook for 2026 that starts to blow out. The sum starts to build out to a more dovish setting, and stock markets drift higher. So it seems like the rally for the better part of the past 5 months has been about little more, in this context, certainly. Surely there were some other influences too, but the most convincing story seems to be that it's about oncoming stimulus. It's about cheap money. And at this point, if we consider where we are numerically, we're already starting to exceed where that April bottom was. So, on the whole, the vulnerability here is the markets have become very dovish. The Fed is widely expected to do at least some amount of easing, so that much is non-controversial and probably not going to move the markets this way or that. The big question becomes, will they move their forecast? Which again, in June, had from 3.9 to 3.6 in 2026, just one rate cut. This is a move of 0.3, obviously rounded off from 0.25. This is a single move. Whereas for the Fed, in contrast with the markets, the gap is almost 50 basis points. A little bit more, in fact. And so this now sets up the risk in this Fed policy announcement coming out of last week, that the Fed isn't going to go the market's way. Now, why would that be? Well, maybe we'll find out this week, courtesy of U.S. inflation data. And we can see there's quite a bit of it on the menu. We already got an uptick in this survey of consumer inflation expectations. But the meat really is Wednesday and, of course, Thursday. Wednesday, we're going to get the PPI report. Thursday, we're going to get the CPI report. So this is wholesale inflation, retail inflation. And we can see here, we're expecting a relatively modest further increase in PPI, only 0.3% after 0.9% last month. The year-on-year figures here seen coming in a little bit, at least for the core, from 3.7 to 3.5. Headline seen holding unchanged. This will be very important stage setting for the CPI report to follow, because we've already seen in this PPI report this very significant jump in the July figures that told us we are now starting to see wholesalers really pass the cost of tariffs down to consumers. This mostly reflects rebuilding margins after this period of weakness here at the start of the year, where businesses basically said, we're going to eat the tariff costs. We're not going to pass it on to consumers. We're going to take the tariff costs out of our own profit margins, and we're going to insulate consumers lest we destroy demand for our own stuff without knowing what the tariffs are really going to do. Well, now it looks like they've decided they have enough conviction to say, you know what, consumers, you pay for it. And so margins have built back out, and so you get this sharp jump in wholesale inflation. We'll see if that continues to surprise higher in this go-around. And of course, if it does, it'll be good stage setting for the main story. The headline inflation rate seen going up from 2.7 to 2.9. The core rate seen holding at 3.1. We can see that here. If this were to surprise on the top side, then of course the likelihood that the Fed would meet the markets where they are on this expansive 2026 outlook would be significantly diminished. There'd be a lot of consternation perhaps about a Fed that surprises on the hawkish side, not because it doesn't cut, but because it doesn't endorse this expansive dovish outlook thereafter, beyond the calendar turn to 2026. And certainly if the PPI numbers are hot going into the CPI report, the concern would be that this too would start to roll up and get the Fed into a more sort of concern about inflation becoming sticky were they to act with more conviction. And we see that in the sort of last bit of data here for the end of the week. We're going to get the University of Michigan Consumer Confidence Survey, and that's got an inflation expectations component, in particular this one-year inflation expectations component. It was 4.8 last time, which is a rebound. We'd started to come down from kind of April's peaks where there was that freak out around Liberation Day. That was a peak of 6.6. And we can see here that really since the COVID inflation scare reached its peak and the Fed started to really hike rates in early 2022, and until this tariff spook, the trend has been lower inflation expectations, improved consumer confidence, until we get into the beginning of this year. And it's here that we start seeing, tariffs, inflation expectations come back up, consumer confidence falls back down. We'll see how overall consumers' mood holds up. Of course, we've already had very weak consumption in the first half of this year, the weakest, in fact, the weakest 6 months since the first 6 months of 2020, which is the COVID recession onset. And so already there is a sense that consumers are feeling the pain, and the pass-through, as we just saw, is only just getting started. If that continues, then indeed we might have a further pickup in inflation expectations. The Fed would certainly worry about that becoming entrenched, and that could limit their scope for easing next year, at least in their mind, which would be at odds with where the markets are. And that, of course, creates a significant risk for stocks. I mean, if you thought that much of this was contingent on what's going on here, at least to some extent, at least let's say for half of the move, well, then you have a meaningful discount here if these expansive expectations are not met. And moreover, if we consider what the dollar is doing, it's of course a little bit down in the wake of the jobs data on Friday, but it hasn't made a lower low of consequence since the beginning of July. Meanwhile, as we just saw, gold is surging, bond yields are cracking lower in earnest. The outlook for the Fed is becoming ever more dovish, but the dollar strangely seems like it's done declining. It hasn't found the impetus for a rally. Certainly, if the Fed were to leave the markets hanging on next year's rate cut outlook, that would start to look like a reason for the dollar to go up in earnest, especially if it were powered by risk aversion as well as a rethink on Fed policy expectations. So we have a situation where the market seems to be sniffing out something. Maybe a turn in stocks, maybe a turn in the dollar, and this inflation data is going to be critical stage setting for what may happen then next week to really catalyze these changes. Outside of the US, we've got a monetary policy announcement from the ECB. We see here no changes being baked in. So the current rate here, the baseline deposit rate, stuck at 2, and we can see through the rest of the year, these month-based Ionia futures are telling us we're shy of 1.75. In other words, there's no cut that's baked in, and we can see that here. The change here, only about a 5 basis point cut that's baked in. For next year, again, a pittance, only about 8-9 basis points in a cut that's priced in for next year. In other words, we're looking at stasis on ECB rates. We'll see what they say. We'll see how that influences the equation here. But of course, it's coming out the same day as the CPI report, so this might be something of a non-event this go-round. We're also going to get a bit of data out of China, in particular the inflation report coming on Wednesday ahead of PPI in the US. So perhaps we get a little bit more maneuver there. And what's interesting is that year on year, we're still expecting ongoing deflation for wholesale prices, but for CPI, we're expected to come in from flat to, again, negative 0.2%, essentially saying there's no demand to speak of in the world's second largest economy still. It's now been mired in economy-wide deflation for 9 consecutive quarters. There's been some stirrings of activity, perhaps, but consumers over there still seem perfectly content to stash their money into savings accounts, and there's really no demand to speak of to power the economy forward. So if the U.S. economy were to falter, we really don't have a plan B. Europe is at standstill, as evidenced by stasis at the ECB, among other things, and China still can't get the engine revving, going on 2 years now. So as we look at what's going on then, it really is all about the U.S. Over the weekend, we had some data out of China on the trade side, which we can see gave us cooling exports and imports. So it really is about the Fed. It really is about the U.S. economy, because without that, we don't really have much of a global business cycle catalyst to speak of. As far as positioning goes, still familiar exposure, not really much to update here. Still long the dollar, looking for it to bottom, long it against the Aussie, so short that, the pound, the euro, and the Canadian dollar. Still looking at long gold, short the put there in GLD at 330, and of course it's working a bit here. Short a bit of Bitcoin, these puts very cheap, and so looking for that to essentially be a little bit of a kicker on this general risk-off bias, looking for stocks to maybe start to look for a top here, or at least the risk-reward on that to look attractive. So still holding these put verticals in the NASDAQ and the S&P 500, and enjoying the rebound in bonds. This is finally working. I was sitting in these positions for 2 months before there was any kind of movement in them, but these call verticals in the long end of the curve finally working, and no reason to get off the boat now, much like gold, until at least there's some kind of a downtick. And that is Macro Money for today. As ever, here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom, commenting at Ilias Pivac on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Snoozer for stocks, but not for gold or bonds. It's Monday, September 8th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilias Spivak in San Francisco, Mike Butler in Chicago, here to take you through the rest of this hour as we wrap up the trading day. If you're on the platform Tasty Trade, on the website tastylive.com, thanks for joining us. Come over to YouTube. Tell us what you think of this market today. What could be the start of a slow week. There's not much by way of an economic calendar the next few days ahead of that inflation report on Thursday, although there are some bond auctions coming up this week that may draw our interest ahead and wrapped around the inflation release. Not like gold and silver are waiting, which continued their extension, gold at a new all-time high here today. But stocks didn't really get the memo. Some of the tech stocks trading a little bit higher, but generally speaking, it's a market that's modest to the upside. 0.5% in the NASDAQ, 0.2% in the S&P 500. Currency space, the dollar is still getting jammed up a little bit here as those lower rates kick in. Mike, I found this to be a pretty uninspiring equity market one way or the other today. Volatility didn't move. It's still an 11.3 IVR here in ESU5. What's your give us your 2 cents here on this market as we embark upon this trading week? 80% of it left to go.
Like you said, it's been interesting for specific sectors, but on Friday, I had an overarching thesis that we will just chop until the rate cut actually happens. So I put on a 1 day. So on Friday, it was a weekend iron condor that I closed this morning. That was a nice winner, but I plan to do the same thing tomorrow. So tomorrow morning, I'll just place a 0-day iron condor. I just think until the 17th, I think we'll just get some chop until the market tells us, or I guess the Fed tells us that the market's been right. Or maybe wrong, but I looked it up today. Now we're getting a 10% probability that we've got a 50 basis point cut in 11 days.
It's
here.
12% now.
Oh, sorry. Yeah, 12%. My bad. But
it's been drifting. It's been drifting all day.
Yeah, but if I've learned one thing from you guys, a 50 basis point cut is no good, and it seems like there's a little disconnect between the equity markets that just are drifting higher and gold that's surging, which would imply maybe the markets are going to see some turmoil, and of course bonds and notes too. So what do you guys think about this? Sell-off incoming, Ilya?
I'm on the same boat as I've been since basically the beginning of August, which is the last time these stock indexes have done anything. And that's really the most interesting thing for me. I mean, if we go back to when CPI came out last time, middle of August, that was the last time that we had any kind of meaningful trend momentum for the S&P 500, say. NASDAQ hasn't even attempted to crack those highs. S&P has been a little bit more chipper. But we established a range top then. We haven't really tried to break it in any kind of consistent way, and we certainly haven't succeeded. And so my playbook has been the same since then. The market knows the cut's coming. That's not controversial. In fact, the market has been at 50 basis points, matching the Fed's stated cadence all the way back to December, at least since May. So the markets have known what the policy is for this year. The big question is next year. And next year, there's a huge disconnect between the Fed and markets. So I think the big thing from the Fed this time isn't going to be the move, unless, of course, they do decide to throw a grenade out there and make it 50 basis points immediately. I think the big question is what's going to happen next year. And there, the Fed's been saying only 25 basis points. The markets are closer to 80. So we're going to have to see some sort of movement on the summary of economic projections in a dovish direction, or I think the market gets upset. Because if you look at these dynamics and sort of the way that the S&P has behaved relative to the outlook for Fed policy through the end of next year, it's been as clear cut as you can possibly imagine. When you get the rebound in stocks from April's lows, the outlook gets, understandably, less dovish because the fear goes away. That ends by mid-May. And from there, the outlook for this year is steady. The outlook for next year is getting increasingly more dovish. We are now more dovish in aggregate than we were in May, than we were in April even, at the lows, and stocks drift higher. Could it be that this move in stocks was first, oh good, Liberation Day isn't a guarantee, but then a month later, okay, rate cuts. And if those rate cuts aren't coming in this kind of volume, that's a lot of upside momentum for stocks that all of a sudden looks mispriced. And sound.
Thanks for that. I always want to just mute the sneezes here. People don't want to listen to me sneeze, right? So we go to a market on Friday where obviously we have the big reversal coming into this week. Will we hold on to that? Will we find continuation? Or we really don't, Ilya? In a certain sense, it kind of reminds me of what happened at the start of August, where you had the big move on the Friday around the jobs data. Europe and Asia come take the baton for the start of the trading week, and they do nothing with it. And so then
they decide not to go,
Right. And then U.S. equity traders today, they push up the market a little bit after Asian and European traders, again, don't take the baton and run it to the downside. Looking at the sector performance here today, I don't think it's going to surprise anyone that the top two are GDX and GDXJ. But for the sake of equity index companies, SMH here is your top performer. Broadcom at the end of last week had a really strong performance. Today, it follows it up with a 3.26% gain. Mike, I'm looking at some of these individual companies that have been leading the charge to the upside, like your Broadcom, your NVIDIA, your Meta. Where's the volatility? I thought August and September were supposed to be the big vol months, according to my little abacus here. How do we deal with a 2.1 IVR in a stock if it's not just Broadcom, but any of these big names?
Yeah, I mean, the earnings this quarter have been pretty wild. Broadcom had earnings a couple days ago. They've had a pretty decent range over the last 2 days, but yeah, volatility's just been crushed in here. I think a lot of the implied volatility that was propping up the IV ranks is now gone, because basically, obviously after an earnings announcement, you're going to get a vol crush across the board, and the VIX is low. So I think a lot of these companies pre-earnings had decent IV ranks, but now with nothing on the horizon in terms of a binary event, you have a bunch of these equities in the 30% range, which is always going to be a low IV rank reading. So yeah, I mean, it's tough to say whether these companies will actually find any reason to come down unless the overall market goes down with a vol pop, because the VIX right now, not looking great, sitting at 15. And more importantly, the vol futures, we've got significant contango right now between the V and the X contract. And both of those are under 20 now. So it feels like the market's telling us nothing to see here. But it seems like we think that maybe this is going to be moving around, at least when the announcement actually comes out, whether they're doing 25 or 50 basis points. For whatever reason, I feel like the market's going to sell off when they do the cut. So in a rare turn of events, I think I'm in line with Ilya here, that when the rate cut hits, whether it's a 25 or 50, everyone gets faked out with a nice big sell-off.
Yeah. And yeah. And I mean, I think the reason for it will be that the cut's not anything like news for anyone at this point. And if the Fed doesn't come through and say, there will be many more cuts next year than we said before, even just one more. Even if they go from 25 to 50 and the market's at 75, if they at least see some movement in their direction, they'll probably find a way to say, okay, fine. But if there's no movement and the commentary is we're still more concerned about inflation than employment, especially while you get signs the economy is reheating. Look at the ISMs, look at the S&P Global PMIs, the tone of data, even just looking at the Atlanta Fed GDP Now model, it wasn't updated strangely on Friday. So you can actually see it up and